Ladies and gentlemen, we kindly request all our members of the audience to please take your seats. We humbly request you to please keep your mobile phones in the silent mode. Thank you. Good morning, ladies and gentlemen, and a very warm welcome to all of you to the Economic Times Budget Analysis Summit 2016. Our knowledge partner for the summit is the Institute of Chartered Accountants of India and our live webcast partner, 24 Frames Digital. Ladies and gentlemen, my name is Kavya R. Chavali, and I would be taking care of the proceedings during the summit. Firstly, my humble apologies for the delayed start. However, we are expecting the arrival of our Honorable Minister of Finance for the state, Shri Sudhir Mungantiwar, anytime soon, which is why we had to begin the session a little late. However, without any further delay, we'll get it started. Ladies and gentlemen, one thing's for sure that the budget 2016 was one of the most awaited budget. However, it did receive mixed response, but it's time to actually hear out from our stakeholders this morning as to what their views are with regard to the budget 2016. Now, to give a head start to the summit, firstly, I'd like to invite on stage Ms. Sandhya Dhar, who's the sector head with Times Conferences Limited, to present the welcome address and welcome all of you this morning. So, ladies and gentlemen, please help me welcome on stage with a warm round of applause, Ms. Sandhya Dhar.
Good morning, ladies and gentlemen. I welcome you all to the Economic Times Post-Budget Analysis Summit. This year's budget has laid down the roadmap for taking India to the next level of growth. We not only see a clear direction in which the economy is going to be steered, but also the key milestones that we need to cross on the way. Honorable Finance Minister Shri Arun Jaitley has identified 9 pillars for having a transforming impact on the economy and life of people, some of which are agriculture, rural sector, social sector and healthcare, education, infrastructure, financial sector, governance, fiscal discipline, ease of business and tax reforms. The budget was presented in the backdrop of an improving rural sector and infrastructure expansion, which were 2 of the prominent features of the Finance Minister's budget speech this year. However, as the Economic Survey pointed out, Indian economy is recovering but yet not soaring, and it was essential to bring the focus back on investments to lend strength to the recovery process. This budget has done just that by stepping up the outlay for the infrastructure sector without compromising on fiscal discipline. With this budget, we also see, after a long time, clear national targets are being set for the year 2022 that would mark 75 years of India's independence. The announcements made by the government, both in the budget as well as outside of it, provide for a concerted effort to move towards these socio-economic targets. Government has also made efforts to move towards a more simplified tax regime by announcing a plan to rationalize direct tax regime for corporates, involving both a reduction in the corporate tax rate from 30% to 25% over the next 4 years, as well as elimination of exemptions. Today, we all have gathered here to hear from experts and industry leaders on how the announcements made in the budget are going to impact the growth of various sectors, primarily financial services, healthcare, agriculture, and other core industries, and also shape up the future of Indian economy. I hope you all have an interesting and insightful day ahead. Thank you very much.
Thank you very much, Sandhya, for setting the tone for the summit. Ladies and gentlemen, on that note, it's our utter delight to introduce our next speaker as he shares a special address with the August gathering. Ladies and gentlemen, he's the president of the ICAI, and he's also now the chairman of all the standing committees of the ICAI. Widely commended and credited for his prominent and distinguished contribution in the conceptualization as well as formulation of the futuristic CA curriculum during his tenure as the chairman of the ICAI Board of Studies in 2014 and 2015. So to present the special address, let's have a warm round of applause and please help me welcome on stage CA M. Devaraja Reddy, the president of ICAI.
Sandhya Dhar, my colleague from ICA, Tarun Gia, our region in charge, Sutisha, ladies and gentlemen, good morning to all of you. I'm very glad to be at this Economic Times Summit with ICA as its knowledge partner. It is a well-timed event when the world economy and more particularly emerging markets like India have to grapple with the recent unusual volatility in the international economic environment, which has not only made the markets to swing on fears with a question as to when there would be recovery, but has also raised the extreme external risks which we need to ponder upon. However, the fact remains that India stands out thanks to its strong and robust structural framework and the governance mechanism. But we need to be more careful with our reforms arrangement as the pressure of this volatility may impact our external factors of growth and may be a hindrance to the rationalization for implementing these reforms. While the impact of the budget on the Indian economy is being addressed in the latter sessions of this summit and also being dealt with at the post-budget memorandum which ICA would be submitting to the Ministry of Finance in few days, I would like to touch upon the structural issues confronting the Indian economy and the role which the accounting profession could play in addressing these issues. Let me begin with the role of ICA as a steadfast regulator, and ICA has come so far and has achieved many milestones in its existence of nearly 67 years, and certainly we need to reach newer journeys and have the capability to scale them. It has given the country more than 250,000 professionals to engage them in the ensuing probity in financial transactions. The Indian economy, despite significant progress made, continues to face the challenge of improving the efficiency and effectiveness of public expenditure. There is a growing concern that the society is not getting value for public money spent on various departmental programs, especially those directed towards rural and agricultural development, employment generation, education, health, and other social welfare schemes. The rural and financial sector continues to largely remain outside the mainstream of the economy. With the presence of chartered accountants, even in the remotest part of the country, the profession is in a better position to promote financial inclusion of rural poor, not having access to finance from formal sources, particularly through microfinance or either innovative measures. The economic reforms in India has paid rich dividends and led by the strong performance of the industry and service sectors, around 7% GDP growth has been achieved, and this has been the trend for the last few years. The country is preparing itself to achieve a high growth rate, and the most distinguished aspect of the growth has been building an environment of stability in macroeconomic and financial terms to achieve public welfare goals. There has been an emergence of World Trade Order which has brought into fold the national economies getting influence through this new market order. But whether benefits of increased trade and growing economic indicators have brought about opportunities for civil society at large, and the way forward to address them remains a cause célèbre. This has sparked a civil society debate and is occupying the center stage of the work program of national policymakers, intellectuals, and the implementation of machinery. The transformation in economic structure in terms of varying portions of different sectors of economy to the GDP would be a welcome considering shift in the focus from being an agrarian economy to economy which graduates to being capital intensive and evolves to value-added services which would ensure an economic development in changing fact of technological and institutional organizations and the resultant income distribution. The ICA is going to partner with the government's efforts in promoting Make in India, suggesting way forward for better facilitation of startups and ease of doing business. Widespread poverty is clearly the major challenge for the developing countries. It is characterized not only by insufficient incomes, but also by limited access to land and capital, poor health and education, and the scarcity of economic and social infrastructure. Given the pervasive nature of poverty, rapid and sustainable economic growth is generally viewed as the primary vehicle for poverty reduction. As a nation, our first priority rightly is to have an equitable development by providing access to basic necessities such as safe drinking water, sanitation, health services delivery, and primary education to bring our rural areas, which are close two-thirds of our population lives, so as to insulate them from vulnerability to undernourishment, ill health, and natural disasters. The focus should also move onto improving the delivery of justice and transparent friendly environment coupled with reforms in good governance policies to boost economic activity. The robust macro level policies have seen growth in all sectors of economy, and the need for value added services by accountancy profession have taken the front position in the economy. While our role as an accountancy profession, a watchdog for ensuring and complying the financial probability and propriety are well established, I am happy to inform that our profession in its own way has also been contributing to the upcoming areas of reforms in urban and local bodies, accounting of NPOs, governmental run entities, to spread its domain beyond the corporate world and thereby reinforcing element of accountability. The environment in which we work has changed dramatically in the last few years, and we are likely to see more significant changes in the upcoming years. Humankind is entering a new era of the intellectual economy when knowledge has become a giant power that brings about wealth and prosperity. In the growth and development of India, the accounting profession, perhaps with one of the largest members in the world, is playing a dynamic role in ensuring stability and sustainability of the national growth. Whether we are working in large, medium, small firms or companies, I believe that our fundamental duty is to the public interest and that our current and future activities must focus on achieving this goal. This is because our profession will have a future, if any, only if it serves and is seen to serve the public interest above all else. The Chartered Accountants profession, since its inception, has been playing a crucial role in the economic development by putting checks and balances at every level of reporting to anchor the economic growth in avoiding the tumult of financial crisis. The profession has always been walking a tightrope to usher the industry towards growth simultaneously promoting the public interest. In my view, the profession will have a pivotal role to play with its rich skills in improving governance, developing standards, framework and procedures in the development of emerging governance model dedicated in the areas of governmental reforms through outcome budgeting, skills development and sustainability reporting. As an economy, we must strive towards tilting focus of our economy policy from target fiscal deficit to fiscal sustainability in long term, and the government in making all attempts to ensure the same. An attempt in this direction is outcome budgeting, which is yet to gain traction in the country's budgeting process. The transformation from the comforts of outlay budgeting to an environment of accountability with outcome budgeting is essential, as in the absence of outcome budgeting, budget management may be ineffective, and ineffective budget management would weaken the public financial management system. A weakened public financial management could even threaten established economic, social and political equilibriums. Good governance is a natural corollary of accounting practices which are transparent, consistent and complete, with provide the stakeholders reliable set of information on the most optimal use of the public resources. The development can be wholesome only in the background of a strong accounting framework. And while the corporate sector is a minuscule component of the overall economic activity, special emphasis on the governmental run bodies, urban local bodies and public sector entities is of crucial importance. The ICA emphasis on transition to accrual accounting to invigorate the financial resources will lead to the hallmark steps in the process of national governance. What is important in today's context is the global interconnectedness. There is no such thing as a local meltdown anymore, and shockwaves don't only emanate from the most powerful nations. Who would have thought, for example, that banking failures in a tiny Iceland or Ireland would be felt in Russia, UK, Scandinavia, and that way would put the life savings of thousands of retirees in those countries at risk. Likely, instability in Europe currency, devaluation China, federal development in US, you name any, and these are examples how the interconnections that work so well in good times as we sell, borrow and do business with entities a continent away can cause such havoc in bad times. Luckily, in India, due to very strong prudential and supervisory norms by the regulatory system, we had less heat. But at the same time, one has to empathize the fact that no national system of regulation can protect its citizens unless it is integrated into an equally rigorous international system. As a true watchdog of financial probity, we must always Ask ourselves, are we using the correct standards and is their application consistent and fair? Are we doing enough to prevent and detect fraud? Are our going concern opinions authoritative enough for the role they are playing in the current environment? Are we balancing accountability of the profession with sustainability and promoting public interest in what we do? In the wake of the financial crisis, the pace of rulemaking in the area of corporate governance and disclosure has increased dramatically, largely driven by responses to the financial crisis. Now, more than ever, there is a new appreciation for the need to align governance with the long-term business strategy, economic stability, and environmental sustainability. Accountancy as a profession has evolved, and I'm happy to say that the Indian chartered accountancy profession has withstood the cauldron caused by financial turmoil and has emerged stronger. The situation has enabled the profession to emerge as much stronger and proactive, and this has empowered the professionals to face the braced new world. The profession today is at crossroads, and like always, it has been testing its moment of truth, and the same exemplifies in consolidation of public trust in the process of financial reporting. The bridging of expectation gap in what an accountant does and what the society believes out of him is going to be cornerstone for the continued success of profession for newer generations. The economic challenges in recent era in context of India are being restructured with the governmental reforms in the area of capital, labor and productivity at macro level, but there is a need to take small steps in the micro units like delivery mechanism, optimization of available resources, quality of spending, public infrastructure and alike. Let us try to plot the economic challenges where Institute of Chartered Accountants of India and its members would be an important player to address out and would be happy to work in collaboration with the government in its right spirit. Some of the key challenges facing ahead are corruption and menace of black money with an anti-money laundering laws and its fulfillment. Ease of doing business in India as an advisory role. Restoring stability and predictability in tax decisions. Enhancing cross-border competitiveness. Moderating overall inflation. Awareness of GST, new bankruptcy procedures and its compliance, implementing the social reforms, improving the quality of spending, encouraging entrepreneurship in the society, serving public interest with strong governance systems. In the premise of these challenges, I am sure that the deliberations that follow will provide a meaningful insight for the policymakers. ICA stands, that is Institute of Chartered Accountants stands, committed in its role of providing sustained and sound financial reporting and assurance practices which are going to be so pivotal to the robustness of economy. Thank you one and all. Thank you.
Well, thank you very much, sir, for sharing your perspectives. On that note, I'd like to also request Ms. Sandhya Adhar to please present a memento as a token of gratitude. If I may once again invite Mr. Reddy on the stage, so if we may please have you for a minute as well. I'm going to request Ms. Sandhya Adhar to please present a memento to our speaker, Mr. Devaraja Reddy. Can we have a warm round of applause one more time, ladies and gentlemen? Thank you once again, sir. Ladies and gentlemen, on that note, we are now about to get started with our first panel discussion for the summit that will be uncovering the ground realities and also impact on the BFSI sector. I'd like to invite on stage our set of panel members to take their seats as well. First, I'd like to invite Mr. Gagan Banga, Vice Chairman and Managing Director, Indiabulls Housing Finance. Let's have a round of applause to welcome Mr. Banga on the stage. May I also invite Mr. Nirmal Jain, Chairman, IIFL Holdings Limited. Mr. Sushil Munot, Chairman and Managing Director, Bank of Maharashtra. Mr. Vikas Khemani, President and CEO, Edelweiss Securities. And moderating our first panel discussion, may I please invite CA Tarun Ghia, Central Council Member of the ICAI. Let's have a huge round of applause, ladies and gentlemen, to welcome all our panel members. It's time to extract more perspectives as well from our set of panel members. I'm going to request them to take their seats as well after they are labeled with the mic. And with that, I'd like to also hand over the proceedings to our session moderator, CA Tarun Ghia. Yes, sir.
Thank you, Economic Times Age, led by the Sandhya Daria, very eminent panel speakers on the banking, finance, insurance, financial sector, Honorable President ICI and my esteemed colleague, leader of the ICI, C.A. Devaraja Reddy, Western India Regional Council Chairman, Chairperson C.A. Shruti Shah, and esteemed participants. The budget has come, as we are aware, in the background. Not only it is the government's claim of the growth story, but you will appreciate that it is the OECD, Organization of Economic Cooperation and Development, singling out Indian economy as the largest developing economy, only one, projected on the firm roadmap at not less than 7% for 16-17, in the midst of gloomy global picture, 3%, China remaining unchanged at 5+%. Also supported by another report, Moody Investor Services, reasoning out primarily on the high and increasing consumer spending and improving investment climate. IMF has also accepted the Indian growth story. And therefore, it is in this midst that we will be discussing the budget, which has been focusing inter alia on the rural economy, infrastructure, make in India, and more importantly, ease of doing the business. In the context of specific focus of this particular session on banking, finance, etc., including the housing sector, housing finance, you will appreciate that the eminent speakers will be giving their views on specific issues which may be raised at the dais, as well as, I think, time permitting, from the participants also. Our broad framework will be including the issues like, India has the huge demand-supply mismatch in the context of housing. So whatsoever rules the government makes, the judicial rulings apart on carpet area, car parking, etc., rules will never succeed till the issue of supply is addressed by making the housing affordable. So government has offered some soaps. To what extent the offer is going to trigger the market in the context of affordable housing? To what extent the additional soaps in the context of interest on housing loan, etc., would be having impact on the banking sector, on the financial sector, etc. We will also be discussing a very, very important area with which the government is concerned with which the finance minister is concerned with, and the economy is concerned with, the PSU banks and the, recognition for the first time at this, RBI level of the increasing PSUs. It is a legacy which is continuing since many, many years. But to what extent the government will be able to address the PSU's problems by encouraging the ARCs, by inviting the FDIs, by making the rules regarding ARC trust, by changing the monetary policy framework, whether it will have effect on the bank rate cut, what are the soaps with regard to retail banking, with regard to what was the view about the private investment cycle, etc. And certainly we'll have the discussions on the aspects of what are the stakeholders' expectations, what were before in the pre-budget and how they have been addressed, and of course on the issues which are concerning on banking finance to the extent tax aspects, whether DDT was really bad or it was rightly there, and how the government has looked at it, whether it has been worsened, whether it has been further strengthened, whether it has been rationalized, and all these aspects. So coming to the specific discussion points of view, I'll be joining the eminent speakers, and we'll have interaction on various such issues as would be arising out of interactions. In the context of budget propositions, I have tried to jot down some of the important points which I consider them important, but suffice to say that the eminent speakers are so much experts in their respective areas and in the context of overall financial sector that they themselves also will be introducing the points which they are considering necessary to express their views. So let me start with the public sector banks, which is so much in news nowadays, and where NPAs have been for the first time recognized at by the such high level, and the government was expected to do quite a lot, and these SOPs of 25,000 crore as per the Indradhanu scheme remaining unchanged, as well as the SOPs in the context of ARCs. ARC trust are being given 100% tax pass-through, and now the non-institutional investors can also have the securities received, securities trust receipts, and the individuals can have also investment in the ARCs. So this and many other aspects, banking board bureau and dispute resolution schemes coming, and the government has said that RBI would be told that to encourage the large borrowers to tap the private market in addition to the banks. So in this midst, whether the banking sector, particularly the PSUs, will get revitalized with these measures, and how the competition between the private sector and the public sector would run through. May I have some views from the learned participants, learned speakers?
Sir, I'll start.
Please, sir.
Thank you, Mr. Ghia, and thank you for inviting all of us here. So we started with the discussion on PSU banks. Public sector banks, the estimated requirement of capital to recapitalize them at whatever existing level of capital they have, and to meet Basel III norm, they require almost around 3,20,000 crores of additional capital by 2018-19. And so in that context, if you really look at 25,000 crores, then I think it's a very small amount, and obviously it can't solve the problem. But when you read between the lines of what Finance Minister spoke, and also what the Minister of State for Finance, Mr. Sinha, also spoke later, I think government is seized of the problem. They realize that PSU banks have a serious problem, but their mindset is that this problem is a legacy and is something which was caused not by this government but has been historically evolved, and they don't want to put taxpayers' money too much into this, but they want to look at out-of-box innovative solutions at this. And there are quite indications that I think they are willing to consolidate PSU banks and also privatize many of them. If you think logically, then very rarely there will be one owner who is having multiple companies doing exactly the same business. So if you look at 27 PSU banks, they do exactly the same business, same owner, they compete on customers, they compete for home loans, they compete for ATMs. It doesn't make sense. But of course there are political ramifications, there are ramifications from employees' perspective, and government has to find an innovative way. Before, in the economic survey, there were also indications that even RBI has significantly excess liquidity. It may be difficult, but government is looking at innovative and different ways to fund PSU banks. And I think as long as they understand the problem and the gravity of the problem, they'll find solutions. Incrementally, we believe that problem is not is happening in the sense that historically there have been a lot of lending in the project finance, multiple problems. There have been some lending that have been politically directed. There are some projects which have been funded and got stuck into several environmental or land clearances. And also the infrastructure projects have not taken off for a variety of reasons. So I think these are all historical issues. Hopefully, as we go along, they will not recur. And I think that is how the problem will get resolved over a period of time.
Okay, I'd like to say it here is, see, first let us look at what is the budget's impact on the banking sector as a whole. And then we can come to the specifics that how much amount is there for the banking sector. The most important thing which I find here is that the government's adherence to fiscal prudence, fiscal discipline, in terms of maintaining the fiscal deficits, is a very important thing in this budget, which in turn has brought the yields down in the market. The interest rates are coming down, and there is a likelihood that there may be a interest rate cut by the RBI also based on that, which all of that will mean that the lending costs will come down for the industry, and there will be a trade growth which can happen in the industry. So that is the first thing which will happen, and it will impact the bank in a much positive manner, in a very strong way. Another important thing for the banks has been that whatever happens in the real economy also affects the banking sector, because everything happens through the BFSI. All impact on the real or to the people from the real sectors is translated through the BFSI sector. For example, anything happening on the rural sector or on the infrastructure sector or on the like manufacturing services sector ultimately gets impacted on the BFSI sector also. So what we find is that in an economy to grow, you need a lot of demand, whether it is consumption demand, investment demand should happen onto it. And there has been somewhat subdued demand in the last few years, especially the rural demand was subdued because of poor rainfall or some drought conditions. So this year the budget has done a very strong emphasis in increasing or making a lot of expenditure on rural development, which will increase the rural demand, the rural incomes, and that will in turn make the banks move forward in terms of their rural lending. A very important thing in that area is also, you can say that irrigation schemes which has been there. Then apart from that also you have a Fasal Bima Yojana which is going to help the farmers in terms of any crop failures. Now that impacts the banking sector actually in a very big way, that when the crop failure is there, you have a lot of NPAs which are coming up into agricultural sector. But the moment you have this kind of a Fasal Bima Yojana, then what will happen? It will give you, the farmer will be able to get the money from which he will be able to make the repayments of the loans. So that is another important thing which is happening from the rural side. The second area where demand creation has happened in a big way is infrastructure. Infrastructure demand creation has happened, if you look at it, on the rural road side, on the roads sector as a whole, as well as on the railway sector. Both these sectors together mean that 2,18,000 crores has been provided for that, which will mean a substantial increase in the demand in the economy. It will substantially mean investment will happen in the economy in these areas. In addition, of course, ports and airports also are being proposed to be developed more. So all this will impact and will give a very positive boost to the banking sector. So from where we see the third impact on the banking sector will be coming in terms of the changes which have been made in the ARC framework. Today ARCs is one vehicle which is able to take over the NPAs of the banking system and resolve them in a much more, you can say, focused manner. Now how do we develop these ARCs? The problem was they were not able to become larger enough because of capital availability. Now 100% capital by the sponsor is also allowed, so that more and more ARCs can come up, even FDI is also allowed. And in the SR, the security receipts, even private investors and others, HNIs and all can also make investments. So more money will be available here to take over the load from the banking sector and NPA. So these are the three basic things which have majorly made an impact on the banking sector. Now let us look at it, what is the requirement from the funding. The 25,000 crores which has been said is only a part of the funding which is there, which has been made over a period of time, which will be there. The government is committed to, has said in the budget speech, that it is committed to giving anything more requirement of the funds is there. Another important thing which has also happened is that there are certain requirements in the Basel III, and we were actually more conservative in that, and we were not recognizing the real estate part of it, which the banks hold. Now that RBI has come out with a circular which makes it recognizable, you will find that another 35 to 40,000 crores of capital, CET capital is going to get added into the banking system. So another 25,000 plus another 35-40,000 gets added here. So slowly, yes, this is going to make a big dent, and it will be and going forward we feel that with the NPA resolution happening, with the demand picking up, then the profitability of the banking sector will also improve, which would also mean more money can be raised from public and other resources also. So these three things together, the banking reforms will also bring in a much better environment for the banking system, and all this together put in as a package will see to it that the banks are going to act and play their due role in the economy with the support of the government.
So thank you very much. With this background that the demand boosted economy Philip and other factors pointed out by Nirmal ji and Sushil ji, we will have some specific questions for the housing sector as well as for the private financial sector, that since funds are going to flow, as Sushil ji rightly mentioned, and the economy is likely to do good, and there are enough buffers also in spite of meeting the deficit targets. One of the areas which the finance minister has tried to address is in the context of affordable housing. In a nutshell, inter alia prescribing the limit that affordable house in a metropolitan city like in Mumbai, Delhi, Kolkata, Madras means not more than 30 square meters of house. That is approximately 325 square feet. And in the other areas, it is 60 square meters, so approximately 640 square feet house is affordable house. And in relation thereto, then there are other benefits being prescribed. 80EE, first time deduction will boost the housing loans to the extent of 35 lakhs per borrower. And added to that will be that I will be addressing specifically first to Gaganji, the Vice Chairman and Managing Director of India Bulls Housing Finance, and then added to that will be, as Sushil ji and Nirmal ji mentioned, that ultimately it is going to be investment driven and the spending driven growth. So in that context, presently as we go through the statistics, more than 80% of the share of the banking is in the hands of PS banks. So what will be the role of the private sector banks and private sector financial institutions, particularly the Edelweiss kind of the financial institution, which Vikas Khemnani, CEO, is heading. So may I request Gagan to kindly enlighten us?
So what the budget has essentially done is made sure that there is no shortage of supply. Historically, the issue in affordable housing has been that the real estate developers who come in to build affordable homes are very small and unorganized players. So therefore, buyers, when they buy their house with them, always have the uncertainty whether the house will ever get completed. With tax SOPs being given and corporate tax being removed, generally the sweet spot for any real estate developer for building anything is around 30% margin. And affordable housing generally happens at about 20%, 22% margin. Now with 35% tax getting removed, there is very high possibility that you will see very large developers who already own very, very large parcels of land in the outskirts of both Bombay, NCR, Bangalore, etc. will all come in, and there will be very large cluster or township development which will happen, which will bring in real supply. And because so much of supply is coming, so prices will not rise. So that will positively impact affordability also. The second thing that the government has done is that in effect it has reduced prices by around 4% by removing service tax from such transactions. So if the entire transaction value was 100 rupees, today it is around 96 rupees. So that 4% correction in prices has also ensured that there is greater affordability, along with the fact that 50,000 rupees of additional tax SOPs have been given when you take a home loan. So today, for a person who is living in a rented house, he is generally paying about 3 to 3.5% of the value of the house as rent. And if he is taking a 25 lakh rupee home loan, then the effective, which is generally given by players at about 9.5%, because of the various tax SOPs around interest and principal, which has now increased to 3.5 lakhs, your effective cost will reduce to only 4%. So you stay in a rented house for 3.5%, you can own your own house for 4%, which is approximately 1,500 rupees a month. And this is a very, very big and important step which the government has taken. If fiscal consolidation continues and interest rates actually fall, my sense is that within this calendar year, you will actually have a scenario where you can own a house at a cost which is cheaper than renting a house. And that generally is the very critical phase where housing really moves very, very fast and at a rapid pace. So a lot of momentum has been given to encourage housing buying. So the government has done both supply side unshackling, it has spurred demand, and on the other side what it has also done is that, which in some ways fits into the context of our first question also, that the one big change that the Indian financial system will see over the course of the next 2 years is that historically all money flow in India has been through the banking system. And the government has done one very vital tax change this time, that it is not putting a withholding tax on securitization trusts. Now that will allow insurance companies, mutual funds, provident funds to start giving monies to a lot of players, be it banks or housing finance companies or NBFCs, who are in turn financing mortgage loans or home loans. So this will ensure that a completely new pool of capital will come into the system and reduce the burden of credit growth from just banks to all of these other entities which were otherwise only investing in GSEC to come in and participate in this market. So all in all, I think the government has done a very holistic solution to affordable housing. It has increased supply, it has improved affordability, it has also very meaningfully increased the money flow into the market. And most definitely, without the prices increasing, you will see that housing demand and actual transactions will significantly go up from here.
I'd like to add just one thing here. The significant portion of what Gagan has said is that today owning a house is becoming cheaper than renting a house. In fact, that would mean definitely for the banking sector, what it means is that much more lending can happen in the housing sector. And that will bring about a real kick-starting the growth or the credit growth in the banking sector, which is on the retail side, the NPAs are pretty low, the loans are very simple, it can be given from all the branches much more easily, and the overall benefit, not just to the housing sector will be there, to the individual, but also to the banks also in terms of improving their profitability and their portfolio. So overall, it gets a very big boost for the sector and for us together with that.
So thank you, Gaganji, Sushilji. Friends, we will come back once again on this renting versus owning, and also the more money flowing into the banking system, how the government is trying to deal with the REITs, how the government is trying to deal with the unaccounted money, the cash transactions, etc. But in the meantime, as I had mentioned, that as per the statistics latest available to me, there are more public sector banks, private sector banks are equal more or less in numbers. Then there are more than both of them is the foreign banks, regional rural banks, cooperative banks, etc. And then we have the roles now enlarged for the ARCs and also the alternate investment funds. To some extent, some adults, pertaining to TDS, withholding tax in respect of non-residents are being removed, and the NBFCs. So what do you see the role of the private sector banks as well as private sector institutions in this entire gamut of banking and finance?
Sure. So I think if you see, banks got nationalized at one point in time, and till the economic liberalization happened, it continued that way. But I think in 90s, privatization of banking sector or financial services sector started with the formation of SEBI and few private bank licenses and all. So till then, the market share of the financial services in public sector owned by almost 100%. As we speak, in last 20-25 years, it has come down to now public sector banks controls almost 75%, and private sector market share of the private sector enterprises is almost about 25%. So this migration has happened in last 20 years post liberalization of the scheme. And in this area also a lot of new avenues have opened, because as the economy opens up, new requirements of the economy happens, the innovation is required around the product, or the innovation is required around the risk management system, innovation is required all over, because new requirement of the economy keeps on changing. So I think this trend is, in my opinion, here to stay. As we move forward in next decade, this will continue to gain, market share will continue to go in favor of private sector banks and private sector enterprises. There's no doubt in my mind. This trend has begun long time ago, and it will continue. Maybe it will get accentuated with this current situation, because I think that, as Nirmalji was saying rightly, that there is no case in having one owner and competing with the same business, in the same business through 28 entities or more entities. So I think consolidation of the banking sector is required. We need large, solid banks who can compete with the private sector banks heads-on in terms of manpower, in terms of balance sheet size, in terms of accessibility to the capital, in terms of providing access to the servicing to the needs of the economy in a most innovative manner. And I think for that, consolidation is must. So I think this trend will happen both in way of losing market share in favor of private sector banks, more and more private sector players coming about, innovation happening, like we have seen now small banks coming about, we've seen payment banks coming about. So this is a trend which will keep on increasing further and further. We didn't have ARCs before, now we have ARCs, and it could become a fairly large, business proposition over the next 5-10 years. We didn't have AIFs, we had only traditional way of managing money. I do believe that, in India kind of economy needs huge amount of asset management capabilities, because as the financial savings keeps on increasing, we can't have plain vanilla products available to the investors or to savers. So we need to have efficient and more diverse product profile products available for the savers, and I think that journey is also, in my opinion, begun. So as we see 10 years down the line, private sector is set to get more and more role, and it will sort of go the way it's been happening. And this current crisis, in my opinion, will force everybody to kind of catalyze and to accentuate this process a lot more. And I think this government, in my opinion, is addressing in very, very sensible manner. One, they are going towards financialization of the savings. I think, how do you channelize and have financial inclusion of larger part of the population. Secondly, I think bringing accountability and providing independence to the banking segment, especially the public sector enterprises. I think so far the current problem which we are seeing in the public sector enterprises because of the political interference and a lot of other related issues. And by this bank bureau formation, I think they are trying to bring autonomy, accountability to the whole system. So they are addressing the problem from the root cause. Obviously, it is taking time, and that's the reason I think then there's a lot of sort of anxiety or around that things are moving slowly. But I guess once this is behind us, we will be on a lot more better footing. But having said that, the private sector will continue to gain the market share.
I'd like to add just one more thing here is, see, in order to service the large Indian market, there is no competition as such between the public or the private sector. Actually, there is going to be a huge amount of partnerships between the public and the private sector, especially in terms of bringing in the non-banking finance companies, NBFCs, then the MFIs sector and others. All these will help us in terms of achieving greater financial inclusion, because not just one sector alone can do it. It is a need and requirement that all sectors get together, and in fact wherever they have the strength, NBFCs have the strength or the MFIs have the strength in reach, the banks have been financing them so that they can take advantage of their reach and reach out to the final consumer on the whole. So it is going to be an era where you will see a lot of partnerships between the new whether it is small finance banks coming up or a payment banks coming up or the NBFCs, all that and the public sector banking will work together to see that more and more financial inclusion is achieved in a much faster way.
So friends, Vikas emphasized the larger role for the private sector banks and private sector financiers, and certainly it gets reflected in the profitability also, which is increasing in their context. Vikas also emphasize the transparency, accountability, autonomy. I think it is a starting point coming in the context of general insurance companies now getting listed. And Sushilji mentioned no competition, all are complementary to each other. So down the line, time permitting, we'll also see whether India doing so well compared to China, or rather China not doing so very well, and world economy not picking up, whether these factors, whether India can remain immune from, or how they should be addressed. But in the meantime, Gagan addressed the very important issue of renting versus owning, and we may ask some direct questions with reference to REITs. We consider that REIT is likely to, if encouraged properly, not only by the central laws, but also the more important state laws in the context of stamp duty, etc., can really flip the real estate market, the infrastructure market, as well as, you will appreciate, the situation which is prevailing in the advanced countries, that one finds it more attractive to hire a house rather than own the house. In India, still the hiring the house is, even though the rent may be possible from the interest income, but because of the demand-supply mismatch, the appreciation aspects, etc., tomorrow the house will become more costly for such factors, that renting is not being encouraged in India because the very, very outdated renting law, even though to some extent streamlined, but not so much streamlined to give safety aspects. And the REIT's role also, where some further concessions in the context of SPV, distributing the dividend to the specified business trust. And add to that, as Sushilji mentioned, Nirmalji mentioned, that funds are going to flow more. In the every budget, we are seeing that the government is trying to tighten the unaccounted monies, the cash transactions. So this budget also very, very, I think, single most proposal in the direct taxes that any transaction in cash in respect of goods or services exceeding rupees 2 lakhs will attract the requirement of tax collection at source. And add to that we'll see how the voluntary disclosure scheme, although the name has been refuted by the finance minister, whether it will survive the test of the Supreme Court, that VDS scheme can come or not. But subject to that, how that also unearths the more money in the market. So we may request the learned speakers on these issues.
So REIT is globally accepted as a very important source of getting money into the real estate industry. In the context of India, I think it will, for at least the foreseeable future, so while structurally all the tax complications have been sorted out, but unfortunately the way that any real estate company generally operates is that they do not have SPVs for specific assets. So there are many assets in one company, and if they try and take that out, there are both capital gains and stamp duty implications. So you will see the light of the day for some REITs to happen. My personal opinion is that REITs over the next 24 to 36 months will get restricted to only a handful of companies which are very office focused, and REITs will be a great tool for them to perhaps raise some equity type of money. In the classic debate of renting and owning, REITs will not so much play that important a role because it will get restricted to more office type of buildings and not residential buildings, at least in the foreseeable future. What one has to always keep in context while doing these debates is that what are the local factors playing. In India, we cannot forget that there are two issues that we have to grapple with. One is that any type of legislative change, especially a legislative change which has to percolate down to states in a federal structure like India, is always going to have its own level of complexity. And two, real estate as a sector is by far the largest employer in the country and is also the largest consumer for very basic and core industries like steel, cement, etc. So given the impact that it has on labor and on core industries, house ownership should actually get encouraged, which is currently being encouraged. Houses should remain affordable, which I think the government has already ensured. And rather than for this government, my small advice would be that rather than trying to worry about running the country through legislative changes, if they can focus on the last mile complexities which are there and solving those last mile complexities. So I think what they've done in affordable housing is just a sample of what can actually happen. What they've done in REIT is again a non-legislative change, but that will actually bring in that kind of capital. And it is this focus which will ensure that houses should remain affordable. If affordability increases and improves, there is no doubt in my mind that the average common Indian would prefer to buy a house, and if he buys a house, there is a momentum which comes into the rest of the economy, and his own income also goes up both directly and indirectly. So all in all, real estate, house affordability is going to be a very important leg for the government to stand on for the next 3 to 4 years.
I'd also like to add up here on this also, that given that the REITs or the infrastructure investment trusts, if they can come more and more onto it, that will take a lot of load away from the banking system. Because all your completed projects and other things can definitely get financed through that segment where people can directly put in money, and banks can do the real job of taking up new proposals or new projects which are there. They can evaluate them and they can finance them, take the initial risk on them, and once they are completed, they are doing very well, they can actually get into this mode of financing through the you can say the individual investors or the high net investors through all these investment trusts. So it will then give a further boost to the country in terms of funds availability for taking up exposure into new projects which are going to come up in the sectors.
So Gagan has rightly emphasized that presently REIT is only in the commercial renting, it is not allowable in the residential property investments, and that rather than legislative changes, the economic aspect should be addressed so as to increase the supply of the housing stock to address the requirement of the common man. And I may add that time permitting, Gagan and other eminent speakers may also address the issue of title title insurance. Once the title insurance, is possible, then lot many complexities of the real estate may be addressed to. And Sushilji has mentioned the private sector investment. We are down the line, Sushilji, also you may address the issue of private sector investment cycle and when the effects may start getting generated. In the meantime, the funds flowing, the other issues will also get added up, that the startups are being encouraged and they are also subject to private sector investment cycle, to what extent it will fill up the economy. And MET is continuing on all these aspects. So apparently 100% tax deduction is not there in either startups cases or in the affordable housing cases. And then adding to that, the insurance sector, which is quite in prominence in these budget propositions, that as much as 49% now FDI being made into the automatic route from the 26 earlier automatic route and approval route 49%, and all pervasive this Pradhan Mantri's Bima Vikas Yojana, that at the negligible premium by farmers, that they will be able to get good compensation in case of eventualities. And more importantly, the social security on a long-term basis being, thought in the context of rural economy and the farmers, that the irrigation, as you rightly mentioned earlier, and the private sector insurance, etc. To what extent the insurance is likely to, have an impact on the financial sector.
Insurance
So-
sector? you're saying?
Insurance sector, including the pension sector also we may address, NPS being made now 40% tax-free.
So, pension sector and insurance sector are a little different. Insurance sector, if you really notice, in the last 6 years has been actually degrowing and has not grown significantly. Now, there are quite a few regulatory changes that happened. The regulators have also come down very heavily on the mis-selling and other complaints. And with that, historically, if you just see, then the private sector basically grew very rapidly, and that growth was, to some extent, was not healthy. And when the regulators came down, they came down very heavily. There is nothing, so there are, when we look at the sector, it's very heterogeneous. Even for housing, when we look at it, so there's affordable housing, which of course, where, as Gagan was saying, that the ownership may become very cheap. But if you go above, in a more premium or a middle segment, then nothing much has changed. Similarly, REIT, of course, will be more viable for commercial transactions. And similarly, in insurance, if you look at the micro insurance, which Pradhan Mantri Yojana and all those things will take care of. So they are very small premium policies which cover very large masses of population for certain very specific aspect. But when we look at insurance penetration, which we say how many lives are covered or how much of property is covered, I think a lot has to happen. And in my understanding, I think the basic framework in terms of regulatory framework or tax framework is already there. As the economy grows and as the confidence of private sector insurance players come back, and as they are able to raise more FDI capital with easier FDI norms, it took almost more than 10 years for FDI policy to change from 26 to 49%. Then the first change that happened last year had requirement of FIPB approval, that also is removed, and we have to wait for the notification to come through. As more foreign capital can come in and a few viable players will survive, I think there will be consolidation in this industry also. So these are more macroeconomic things that will drive insurance penetration rather than the budgetary changes. And to some extent that will be true for other sectors as well. As Mr. Munot originally, in his initial comments, he pointed out that macroeconomic discipline has been maintained, so that will make sure that the interest rate goes down. And we have seen earlier also, when the interest rate becomes single digit, then there's a significant boost to housing and other sectors, which has a cascading benefit to, say, steel, cement, labor, and many other sectors. As the labor gets more income, there will be more demand for the consumer products also. So I think this virtuous cycle has to get a fillip through the overall growth, and to that extent all the sectors are interrelated. Even if there is investment in road sector, railway sector, that will have a positive impact on housing sector as well. So I think what we have to look at on the broader or on the more macro perspective is that the budget will put the economic growth on the faster track, and I think that will benefit all the sectors.
See,
And financial sector will be the primary beneficiary of that.
If I were to add that, I think if you look at this very broad trend, and budget is just a part of that, according to me, one of the big flagship initiative of this government is to do financial inclusion for all. And what do they mean by financial inclusion? I think people so far, a large part of our population was saving money into unorganized sector, and they were borrowing from unorganized sector, and in the process they were not getting benefit of lots of benefits which we are all getting, being part of the financial system. So right from the time they came, they opened, brought 20 crores families into banking system. By linking that, they are also giving them the opportunity to save, which was going into otherwise unorganized sector or the physical sector. So you are bringing a huge amount of capital which was otherwise physical or lying is coming into the organized sector. Now linking the wider population through the health, universal health system, and also provide them the securities through the NPS system security for retirement. So they are plugging in one by one, I think various through their various programs, bringing a larger part of the population into the financial system. And I think this will have a far-reaching impact, not now or not immediately, in terms of growing the financial sector, growing the economy, and overall well-being of the population from 5 to 10 years down the line. And I think right now the framework or the groundwork is being laid for all of these, and that's how I think the starting point was Jan Dhan Yojana, and then I think it is going whether direct benefit transfer to universal health to NPS to many more. So I think we have to see all these things not in isolation as far as the budget proposals are concerned, but I think as a part of a broader plan or a theme or a vision this government has.
I'd just like to add on that only. See, in the financial inclusion space, you have the accounts, the financing part of it, then the lending part of it, which has been there, some lending, overdraft can give. And the third most important, as you said, was the social security mechanism. Now, this has been sought to be created that suppose you have a death, the life insurance is there. We have a Pradhan Mantri Jeevan Jyoti Bima Yojana, you have a Suraksha Bima Yojana, which is there. Then there is a pension Yojana, that is there. And in addition, this time which we have done is that if your crop fails, then you have a crop insurance also, so you have that money. And if your health is a problem, you have a health insurance also. So what we are trying to do is with these 5 types of insurances, we are trying to give a total social security network to the people, especially at the bottom of the segment, which will increase the insurance penetration for the whole. That is one part. The other important thing which I would like to add up on the budget is, a very important thing which is being done here is that Aadhaar is going to be given a statutory thing. Now this has a very important thing for the government as well as for the banking system. For the government, it means that directed payments are made very clearly, so direct benefit transfer happens, so your subsidy payments get directed and get reduced substantially on the whole. All the fringes and other things get removed out of it, and you get more directly, the beneficiaries are given the money. So that is a very big benefit, and savings will happen in terms of the amount which they can save in subsidies. And for the banking system, it happens is that though once they have brought in all the PMJDY, those accounts have come in. These accounts will become now more profitable for the banking system because the subsidy money will start flowing into those accounts, and we will have more float available to us in that system for us. Not only that, there will be some amount of transfer. Whenever transfer is there, a commission of 5 rupees per transaction is also going to come to the banking system. So it will not only give a boost to the government in terms of reducing the expenditures on subsidies, as well as to the banking system in terms of better financial inclusion, more incomes to the sector.
Just to add to the pension point, which we are discussing, I think now the government has made it exempt for the EPF, and I think EPS and NPS, they are getting tax break, which is very welcome move, because today India is a young country, but 25 years later, the government doesn't have any social security program the way European or developed countries have. So in that context, if they can encourage people to save for retirement, is always a very positive move.
So as it comes out, the spread of the social security schemes being increased in multiple manners, and the FDI and other measures increasing the flow of the money in the insurance sector, and together with that Nirmal mentioned the private sector and the role of the regulators, I think a move has been now made by the general insurance companies held by the government to get listed. So that should, I think, inculcate the required accountability, transparency, and then the money flowing to the private sector insurance companies also. So if there are any views, otherwise we'll move to the infrastructure. Cess is being increased, which may affect the sale of the car, and the insurance premium is around 40% of the general insurance premium in the sale of car, in the vehicle segment.
So this is a question to.
If there are any further views, because listing of the general insurance business, the
Listing in general is positive, but I think that there is still a long distance for insurance companies to travel before they can get listed. The last 3 to 4 years have been years of turmoil at the corporate level for insurance companies. And while the government has done undoubtedly a lot to ensure the bottom end of the pyramid, but the middle classes as well as the upper middle classes also need to develop a habit of insurance, be it on the general health or life side. I think there the penetration in India is still extremely low. And at a corporate level, as far as listing is concerned, I think most insurance companies over the last 3 to 4 years have actually reported extremely poor financials. So while it may be an enablement for them to get listed before the market really has absorption for paper of insurance companies other than the top 1 or 2 private players, I think it's still a long while to go, and both the government as well as the regulator will have to, they've done a stellar job as far as stopping mis-selling, etc. is concerned. But the role of any regulator is not only to regulate, it is also to develop. I think the development of the insurance sector now needs to be the agenda for the next 2 to 3 years before listing, etc. can actually fructify.
Coming to your question on the tax and the cess which has been increased on luxury products. So I think there's all round increase in the tax on the rich and the wealthy people and lot more money is being mobilized. But if you look at the objective of that is basically that every village will have a road in next say 3 years time, and every village household will have a cooking gas. So it's very laudable objectives. And if money is going there, I think most of the rich or wealthy people don't mind it that way. Only thing is, and one very pragmatic thing about this government is, and which is really appreciable is, they kept the Aadhaar scheme, because when this government came to power, there were a few political leaders who were talking about Aadhaar being badly misused by Bangladeshi immigrants and this needs to be solved. But I think when government analyzed and they realized that this scheme probably can be revolutionary, and this is something which is the most powerful thing that has happened in India to prevent corruption, to prevent leakages and do the direct benefit transfer and many other benefits that come along with it. They kept, and now they are going one step further to give it legal backing. Another positive thing is, they were critical about the Narega scheme or Manrega or whatever you call it. Manrega. Manrega scheme also, they tried to reduce the resources in the early part of this thing, but they realized that today, in a way, how this, maybe this scheme was conceived as a scheme to get vote, but has a lot of positive impact on the economy, because this puts a lot of money in the hands of rural households, which are majority in number, and that basically has a positive impact on the demand and therefore on the industrial and services sector as well. So I think they put more resources in Manrega, and as Mr. Manoj was saying, that this will boost the demand side. So when you look at GDP, there are two sides of it. One is that one boost has to come from the demand side and the other from the investment side. So in a way, these are very positive things, and hopefully that would accelerate the economic growth, and that is the objective of the.
So again, we'll go to this aspect of more resources. We'll try to list out the areas where more resources are specifically coming, and Aadhaar is being given the legal backing. It had lost the some shine of the legal backing because of the Supreme Court judgment that it cannot be the basis for all these benefits. Can we consider some aspects before that of the mutual funds? That mutual funds, particularly to some extent, a very little hurdle is being removed in the context of non-residents receiving the dividend, that 10% withholding tax will not apply because of the DTA benefit whenever it is available. Then this mutual funds dividend has not been touched upon in this additional 10% tax on the dividend income. So dividend income, additional 10 lakhs, liable to be taxed at 10% in addition to DDT for taxing the super rich, is confined only to the dividend from domestic companies, and that also to the individuals, HUFs and firms, all residents. the dividend from mutual funds has not been touched upon. Then the other areas where, consolidation of the mutual fund plans, many of the hurdles, connected with the individual HUFs who are more holding the units are also being removed, that they also will be tax-free in the context of consolidation of the mutual funds. And there may be some more areas in the view of the eminent panel members. So can we consider some role of the mutual funds, how they are performing and how they should be
So
performing?
mutual funds are going to be becoming, and asset management in general is going to be becoming a very important source of tapping both savings, as well as is going to in the future take a lot of load off the banking system. Earlier in this discussion I had highlighted how mutual funds will now effectively start also financing the mortgage sector. I think the dividend part not being taxed is a thought through piece, and it is an extension of what the government is otherwise saying, which is that financial savings have to be encouraged as against savings happening in instruments such as or avenues such as gold. And if tax is to be applied, then that will actually become that will be like effectively discouraging the system. So what the government will do well is by leaving tax laws around mutual funds alone for the next few years, getting a lot of predictability around returns and how they would get taxed. And in turn, like the last 2 to 3 years as the equity markets rose, what one saw was that a lot of retail money came in to the equity markets this time around through the mutual fund route. And on the downward cycle, because it was professional money managers who were managing, the pain when the markets corrected almost 20-25%, the pain was felt by the retail investor a lot less. So I think the role of the asset manager, the professional money manager, is going to only facilitate savings in the right and productive sectors, which are financial savings. And mutual funds will play a very, very important role as far as that part is concerned. And as AUM grows and the constitution of that AUM changes from it being 2-month money to becoming more like 3-4 year money, as SIPs become more and more popular in the country, I think the power of mutual funds to actually take on a lot more of the type of debt that banks are actually doing today is going to become a reality.
Thank you.
Just on a dividend distribution tax. So dividend distribution tax is not a good tax in principle, because you have a corporate profits that get taxed at 34%, then there's a dividend distribution tax of another 20% odd, and on top of that there's a 10% tax, so it's taxed triple, thrice. Now you just take an example of, say, somebody like Mr. Ajim Premji, if he's owning Wipro, so he pays 34% tax, and on the dividend there's a double 20% as well as 10% taxation. And if this company were owned as a sole proprietorship or a partnership, then the profits that is withdrawing, there would have been only one single tax of 34%. At this point in time, government needs resources for the rural India and agriculture, and maybe, they need to find ways to take it from people who can afford to pay. But these kind of anomalies, what it can do is it may probably reduce the dividend payout of the corporates, and at the end of it, government collects a higher percentage on a lesser dividend, which defeats the purpose itself. But we need to see, my personal view is that this may be a temporary tax. I mean, it should not, the tax which is not good in principle or not good in concept, probably will find it difficult to survive for too long.
So, two issues, the badness of the DDT, I think the next session will elaborately discuss, it is on taxation only, but government has not touched upon the badness and those aspects, but government has only thought, articulated that DDT is 15%, in the hands of a common man, it is exempt, dividend is exempt, in the hands of the super rich also, after meeting 15% it is exempt. So super rich and common men are being put at par, and that is where government has articulated that it is nothing but rationalization of the tax. Now in the midst of friends, you will appreciate that there are so many areas from which the funds are going to flow, the startups, the Manrega, as rightly pointed out by Sushilji, continuing, Jan Dhan Yojana also continuing, the rural spending being getting a boost, the innovations, the royalty, R&D getting encouragement, infrastructure facilities, separate clause is coming in the Income Tax Act, that all the infrastructure new creations, including the housing projects on the highway, will also get 100% benefits. So in the midst of all these, innovative ways in which funds are going to flow in a more, probably systematic way, because cash and unaccounted transactions come under the, they are being dealt with. So how the economy as a whole, the financial sector particularly as a whole, is likely to take a call upon this, some of the measures.
What I can say here is that look, when there is a downturn in economy or the economy is not actually doing that well, which compared to its potential, then there is a need to increase today the public investments, because that will kickstart the economy more on it. And that is why the purpose of all this tax collection seems to be that the more money is to be generated in order to be able to do the public investments more and more. Once public investments start, they start moving the economy forward, then more and more private sector investments also will come into place in it. And I think in the whole theme which we have seen is that this is the basic theme in the whole budget, is that from everywhere more and more, first the public investments come in, then based on that the private investments come in, facilitating those private investments also into various sectors and facilitating the FDI also to come in into the sectors in India. So that all will bring in a boost to the economy and in terms of enhancing growth potential of the economy to reach say maybe 7.5–8% or wherever we can reach to our true potential after that.
See, if you see capital investment to GDP ratio, we are like multi-decade low at this point in time. And one side we are talking about increasing supply side, because eventually as the demand picks up, if supply side does not keep pace, then you will have a inflationary situation. Other side we have this investment ratio being very, very low. I think there is an urgent need to start the investment cycle, which I think this government has articulated well in the budget in terms of allocating the money to infrastructure, roads and ports and railways, and plus also put in money in hands of rural economy, in the rural economy, to roads and again rural roads and various other schemes and use. So I think this will slowly start percolating down. Investment cycle will pick up. That will in turn sort of lead to some sort of job creation and demand creation. So I think if the economic cycle picks up, the financial sector will be obvious beneficiary of that. We have had, because of this poor investment cycle, credit growth, specifically from the corporate segment, almost all-time low or very, very low. So I think that unless that picks up, you can't see banking sector also doing very well. So I think this is a whole, we were in a vicious cycle, and if it starts turning, we will get into a virtuous cycle, and that will have impact on not only banking and financial services, but overall in economy in general.
So the private investment cycle, the gestation period we'll deal with. Learned participants can also join in. One of the important questions that how our economy, which is appearing to be so growth projected, will perform. Is it really immune from the global economy so much? Because the other side, the global economy, not a matter of pride that our economy is doing far better than the it's a case of consolation. And particularly the other, equally competing in all kinds of numbers, the China economy, the growth rate not really enhancing so much. So to what extent the global economy will have impact, and more importantly, we have now more of FDI. FII is continuing the investment. So how that will also affect the Indian financial sector?
So I think there is no doubt on that we are all part of an integrated world. Right now the global situation is very, very complex. We have seen the commodity cycle deflating, and there's with the China growth slowing down and having an impact on the commodity cycle, both metals and the oil and gas. I think this is putting pressure on the overall banking system globally. So India cannot remain unaffected with that, and what we saw in the recent past was a big result of that. But I think all these things augurs very well for India from a long-term perspective. The low commodity prices for a commodity importing or a commodity consuming country is very, very good from again medium to long-term perspective. So currently, what we are going through, and India is a very unique market where we have a investment-led growth, consumption-led growth, so very well all-rounded sort of growth. So I think the key thing right now India is struggling is how to deal with the liquidity-led sort of problem which has got inflicted upon Indian system. And we still by and large remains fairly largely dependent on the foreign capital. So one side we have to become more dependent on domestic capital, which I think is a long-term trend and which will happen because we are no shortage of capital. It is just the only thing is that we need to channelize capital in the right ways to the productive or needing segments of the economy, and which I think is happening. So if you just overlook this next, maybe 6 to 8 or 12 months of period of the, the deflation cycle which is happening in the global markets and the correction in the global banking system, I guess once that anxiety settles down, India will also probably outperform most other markets, because I think India is a very, very unique situation as far as the fundamentals are concerned, as far as the economic growth is concerned. On all stars are aligned. It's just that I think once the global anxiety settles down, we cannot remain isolated from the global economy in this today's day and age. And hence I think that maybe if you overlook next 3 to 6 months, 8 months, this things will start panning out, and Indian economic growth will be far better than the rest of the world.
So out of the total spending power and investment climate being improving, there will be some immediate effects from infra spending, rural spending, and then the further spending by the private sector will depend upon the investment cycle. We may deal with these issues, and there may be some issues in the minds of the learned participants. Their views also are most welcome in the context of the overall scenario, the changing scenario after the post-budget.
Inviting questions from the
Any questions
audience,
anybody has?
from the audience, any questions or anything on that?
So can we then in the meantime identify some areas which will have immediate effect, the short-term effect? Yeah, please. Some.
What I would like to add here in fact is, see, India's growth has all along been based on a buoyant domestic demand. That has always been the case. In fact, there has been some period now where this demand from certain sectors had got contracted, and that is where the whole focus of the budget has been to improve that demand also. Because see, worldwide if the demand is not happening that way, then we need to actually have our own demand growing in, so that the more industries come up, and fund flow is always easily available from international markets. So to that extent, once our demand picks up, more and more money, not only domestic but international money, will also be available to make further growth of the economy.
Yeah, please. And thereafter, whether expectations to increase the demand, as you rightly emphasized, have been met, or to what extent they have been met?
Sir, I hold some shares in a public sector bank, and over the last year it has dropped so badly. I don't know whether I should hold it or I should sell it. Can you please advise?
Yes, capital markets. So, capital markets, Mr. Jain.
So, this is not actually the topic for this panel.
Okay, I'm sorry.
So, it will be out of context
We can't do that.
get into stocks, but every stock has to be looked at separately. So, you have to basically.
I have in SBI, sir. SBI.
So, I think there are research analysts who can always advise you on this.
Sure.
I mean, we can discuss, but we'll be digressing from the topic. Probably not. We can
Very true, very true. And Governor has said, RBI, that discipline first and then growth of the public sector banks.
Yeah.
So, any other views in the context?
Yeah. There.
So you mentioned in the course of the conclusion that commodity cycle now is at its lowest, and low commodity prices augur well for India. But you see the global contagion effect because of the low commodity prices and also the crude prices, and then we say, okay, if crude and commodity goes up and then the market improves, again there is a improvement in the credit cycles, and then there is an optimism, and then there is an FII flow. So you really think in the long term it will stabilize so as to benefit India, so that the commodity prices reflect the real demand supply equilibrium, or this will be driven more by money chasing the equilibrium because of the credit and banking and global currency equilibrium, which will in turn lead commodity cycles to go up. So which is better for India, right? I mean, in terms of low commodity prices stabilizing in the long term, or having good contagion effect because of the credit and currency optimism.
So, India is a net importer of commodities. So, on a very macro level, if the commodity prices are going down, India benefits. So, if you look at crude oil, then India on a net basis, I'm saying net of the re-export, imports about 900 million barrels. So, almost about $1 billion. So, every dollar benefits the country by $1 billion. Now the benefit can be shared by the government, by the corporates, by the consumers. In the last year, government has increased tax and taken away the large part of benefit, and helped in fiscal deficit and fiscal consolidation. So on the, if you look at medium to long term, then the commodity prices being low will always benefit India. Going forward, India will also be the largest consumer of commodities, because if you look at all metals, whether it's aluminum, steel, or even other commodities, then India is a growing economy and needs a lot more as compared to say China, where at least infrastructure is mature, the population is not growing rapidly. So on the macro level, to answer your first part of question, commodity prices being low will benefit India. As far as stock market, economy and investment cycles are concerned, of course there will be a readjustment period, because we don't visualize significant large investment getting into say steel sector. But over a period of time, we'll see a lot of investment getting into services sector, financial sector, and that will catch up and make for the investment cycle. Investment cycle will take some, so they are in a way a little unrelated, but maybe very linked in a far manner. In the short term and medium term, there can be an impact, because globally that can impact the emerging market flows, that can impact the sentiment about the financial stability. But I think they'll be all short term. So on the long term, the economy benefits from this.
Yeah, please.
Hello, yeah, I am audible, no, sir?
Yes.
Sir, in the recent proposed budget, the government has encouraged the infrastructure projects by allocating lot of funds for the infrastructure at one side, and the other side the government is gradually shelving down the benefits or subsidies so far which was exempted. They are shelving out the subsidies so that the companies stop claiming exemption on that. So doesn't it contradictory? And secondly, also the service tax has been increased by half percent further. So doesn't it contradictory to the common man's interest?
I think your point is with reference to infra spending, encouraged vis-a-vis subsidy, rather exemptions getting reduced.
Yeah, right.
That appears to be the question, isn't it?
Yeah, because in the previous budget they told that gradually the corporate tax will be slowed down from 30 to 25%. But in this particular budget, it has reduced only 1%, 29%, and that to a very small turnover group companies.
For the startup companies, it will be 25%.
Yeah,
subject
right.
to non-availing all those added benefits
Yeah.
of investment-linked benefits, profit-linked benefits. But it appears that the government thought that once upon a time, all these exemptions had their place to encourage particular geographical development, to encourage particular sectors. But now probably, out of these exemptions, the corporates are paying less tax and planning is becoming more important, the kinds of the things. Nirmalji, you mentioned the oil prices also, which has certainly helped the, economy. Whether exports also will get affected due to the recessionary markets, abroad.
No doubt they will be affected. But on a relative basis, because India has a significant IT exports and services, IT services in particular, and as long as the US economy is doing well, the growth will slow down. But relative to other Asian economies, we may be less impacted, but it will require a lot of impetus from the government. There will be an impact because of the global demand slowdown, and we already seen that in last 11 months.
And while exports will slow down, I think the foundation on which the Indian economy stands is domestic consumption, as Mr. Manoj said. And with oil being where it is, fiscal deficit being where it is, the big needle mover as far as the Indian corporate sector is going to be how interest rates come down. And interest rates come down, can only come down if fiscal deficit is being managed well. So I think in all, what commodity prices reduction will do is land up reducing interest rates indirectly in India, which will spur local demand, which should be a lot bigger a number mover as against the fall in the exports.
So thank you very much. In fact, as the virtual conclusion coming is that demand-based, spending-based growth is, highly projected. And therefore, we had always, and we have the worries of the great numbers that we are having, and that great numbers is, giving the positive implications also in the run-up to the, India may be emerging as the economic leader by 2025, some of the forecast. If there are other views, otherwise I leave it to
Just
the...
one, can I have one question, please? Here, Tarun bhai. These measures which are announced, in the budget regarding international financial center to make in the GIFT City, whether in your opinion, whether these measures are sufficient compared to the, local international, measures which are available in the worldwide international financial service center? Because, even there MAT is levied at 9%, whereas in some of the countries, there may not be any taxation.
See, there can always be a discussion on how much is the benefit being extended or anywhere, but at least it's a step forward, a lot of steps forward actually, in terms of improving the, we can say, the efficiency or the attractiveness of the GIFT City, that kind of things. So that is there, it's a running thing, and it will keep continuing maybe next year again, furthermore we will see.
So friends, we had the benefit of all the eminent personalities. I may repeat: Gagan Banga, Vice Chairman and Managing Director of India Bulls Housing Finance; Nirmal Jain, Chairman IIFL Holdings Limited; Vikas Khemnani, President and CEO of Edelweiss Finance; and Sushil Mohnot, CMD of the Bank of Maharashtra. The time is getting over. Thank you very much for all the very eminent personalities, and I am sure that some of the issues raised in the context of taxation, the next session, when you participate, you will be more, elaborate in your approach towards the impact on various these segments. May I therefore request the Edge.
Well, yes, sir. Thank you very much indeed. Firstly, can we have a round of applause to thank all of our eminent panel members? Thank you very much, sir, for sharing your wonderful perspectives. But on that note, I'd like to invite Soumya from Times Conferences Limited to also hand over a memento as a token of gratitude to all of our panel members. Well, I do believe there have been some more questions and queries from the audience members. Of course, I'm going to request all of you to please connect with all of our speakers during the breaks, especially in case of any further queries. All right, so once again, thank you very much, gentlemen. Thank you once again indeed. Let's have a round of applause to thank our first set of panel members indeed. We'll request you all to please come together for a group photograph as well. And with that, ladies and gentlemen, it's time to set the stage as well for our next panel discussion on the tax reforms and the changes in the corporate and personal income tax and the subsequent impact on the investors. So once again, I'm also going to request all the members of the audience to please feel free to connect with all of our speakers in case of any further questions. Of course, on that note, it's also time to get started with our next panel discussion. Ladies and gentlemen, on that note, all right, so we're just going to take exactly a couple of minutes as well to just set the stage for our next set of panel members. Meanwhile, could I request our team to please lapel mics to all of our panel members as well? And I'm also going to request our members of the audience to please remain, as it's still time for another panel discussion as well. So yes, I'm going to request all of you to please remain as well inside the hall. Ladies and gentlemen, moderating the panel discussion, we have with us Mr. Saumil Shah, who's a partner and head of private equity tax with KPMG in India. And I'd like to invite on stage firstly our session moderator, Mr. Saumil Shah as well, to please come on the stage. Meanwhile, I'd also like to invite our next set of panel members. We have with us CA Dinal Shah, who's the Chairman, Corporate Laws and Corporate Governance Committee, ICAI. We also have the presence of Mr. D.S. Saxena, who's the Principal Chief Commissioner of Income Tax, Mumbai, and Mr. Manish Vora, who's the Chief Financial Officer with Johnson & Johnson, and Mr. Ramesh Khaitan, Global Head and Vice President, Taxation with Lupin. So can we have a warm round of applause as I welcome all of our panel members on the stage. If I may please request all our gentlemen to please come on stage. Also our session moderator, Mr. Somal Shah. Looks like we have taken care of the technical aspects with the mic plugging. Wonderful indeed. Meanwhile, I also request our final speaker to please join our set of panel members, and I'd like to hand over the proceedings to our session moderator, Mr. Somal Shah. Over to you, sir.
Thank you.
Good afternoon, friends. While the mics are being labeled, let me do a quick round of introduction. To my right, we've got Mr. D.S. Saxena. He is the Principal Commissioner of Income Tax.
Principal Chief Commissioner.
Principal Chief Commissioner of Income Tax. He holds a master's degree from Lucknow University and LLB from Mumbai University. And he's also participated in the Global Leader Program at Wharton College. Welcome, sir. To my extreme left, we've got Ramesh Khaitan, who is currently a Senior Vice President and a Global Head of Tax at Lupin Limited, which is a $2.5 billion company with operations in 12 countries. He commands 2.5 decades of tax experience in taxation matters. He also serves on the Direct Tax Committee of the Indian Merchant Chamber, as well as he's currently also writing a book on direct taxes. Welcome, Mr. Khaitan.
Thank you.
To my left is Manish Vora, who is the CFO of Johnson & Johnson's India operations. He has over 17 years of experience and in various industries like medical devices, FMCG, chemicals and pharmaceuticals. Manish is also a rank holder and a CPA, rank holder in Chartered Accountancy and CPA from United States. He is currently pursuing his executive education from Harvard University. And to my extreme right is Mr. Dinal Shah, who is a partner with EY and is based out of Ahmedabad. Currently, he is serving as the chairman of Corporate Law and Corporate Governance Committee of the Institute of Chartered Accountants. Thank you, gentlemen, for taking out time and participating. Let me start with, sir, asking you a question on the budget highlights. One of the important highlights of this year's budget was the fiscal prudence and the finance minister's commitment of achieving 3.5% fiscal deficit target. Do you think it's possible, given the 7th pay commission and the one rank, one pension commitment that the government has given? How do we see the direct tax collections to cover up for these revisions that we have?
I think direct taxes won't cover the entire amount of these enhanced expenditure. I think indirect taxes would have to contribute more indirect taxes have now increased very much, because if you see, there is a levy on petroleum. So that is giving a lot of tax to the government, because petroleum prices are going down, but the levy is increasing all the time, which keeps the price at a very high level. And in this year also, indirect taxes is going to give us surplus. So I think most of these things will have to come from indirect taxes.
Wonderful. Khaitanji, I'd like to ask you one question. As they say, no matter how bad a child is, he's always good enough for a tax reduction. But given the roadmap of phasing out tax incentives and rationalization of tax incentives, do you think this is a good roadmap, or there should still be further time period given to the industry?
I think it's a good roadmap to bring down the taxes, at the same time taking away all the incentives. The good part would be that it will reduce the litigation and lot of arbitrariness. And but the worst part is that now the finance minister has said in this budget that he is taking out a lot of incentives, like investment allowance from next year. Accelerated depreciation he has already reduced and restricted it to 60%. But the tax rate has not been brought down to 25. He has said over a period of 5 years we will bring down the tax rate to 25%. Now even if the tax rate is brought down to 35%, then it will be in the range of 29%, some 29 and 30%, because we are not talking about the abolishment of surcharge and education cess. So still India would be will not be so competitive as with respect to like China, Singapore and other countries like UK also. Every country is, even Japan, which was a very high tax incidence country, earlier it used to be 42%, now they have brought it down to 35% this year. Again they are talking, will bring down the tax rate. So I think in order to attract more and more investment and to make this Make in India stories successful, we need to bring down our tax rates. At least we should be in comparison with China, which is at this rate, they are at this point of time they are charging 25% without any surcharge and education cess. So it's a high time that we should take away the incentives but bring down the tax rate.
And also we take away the surcharge.
Yes, otherwise there is no point, because over the years we had earlier surcharge was 2.5%, then it was picked up to 5%, then 7.5%, then 10%. Last year it was increased to 12%. Then we have education cess, which was 2%, then it was again brought back to 3% by another levy. Now we have Krishan cess also. So this is going to increase. At the one point of time, at one hand you are saying we are bringing down the tax rate, but on the other hand you are bringing other levies. So effectively it is increasing the tax rate.
Would you start a new manufacturing company and take benefit of the 25% corporate tax rate?
See, if you start a new manufacturing company, that is the law says if it is set up and registered after 1st March 2016, then you will not be given any incentive based or profit based or accelerated depreciation etc. deductions. So no 10A, SEZ 10AA deduction, no chapter 6A deductions etc. everything. If you think that if you compare the tax rate at the moment, and if you take into incentives into account, accelerated depreciation, then investment allowance, then the tax rate is below 25%. Effective ETR, I am saying it is around 23-24%. In my case, in my company, now most of our units are not enjoying any tax shields. But on account of vetted R&D and investment allowance, accelerated depreciation, etc., that kind of thing, the tax rate is, including surcharge, is around 23-24%. So if you bring it down to 25%, and then over top of all, they are saying that normal depreciation will again be recomputed as per the rules to be notified. So I don't think this 25% tax rate, though it looks 25%, it will be, if you add surcharge and education cess, again I'm saying it will come down to 29, 30%. And then the depreciation is again recomputed, then your tax rate will go up. So I don't think it's a kind of incentive.
And interesting in this proposal, they've not made an exception that a business should not be carved out of an existing business, or it should not be set up by way of a reorganization or a restructuring of existing operations.
It is not carved out, but the thing is that they are saying the company should be set up and registered.
Yes.
So only exception is that you convert into, you convert a LLP or private partnership firm into a company. Only then it will be a company registered. But the catch is that it's your last year's investment in plant and machinery investments should not exceed 5 crores. So that is the catch. So you cannot convert your existing business into. Now, if I take that way, even say if I convert an existing business into a company and I bring old plant and machinery, can that LLP kind of thing, or say earlier existing business is converted into a new company, can that law can be applied to this or not? So there could be another area of litigation.
But what if I start a new manufacturing company after 1st March 2016 and I transfer my existing business, say from a group company to the new company?
That can be done. This doesn't talk about, but again, if you say, if you start a new business, manufacturing company, if the capitalization is huge, I claim additional depreciation, investment allowance, there may be a situation that I may not have sufficient profits, there may be losses also.
So careful analysis needs
to
be
one has
done.
to do the cost benefit analysis, whether, because I have the option of claiming 25% before I file that return of income.
Yes.
So one has to do the careful analysis or cost benefit analysis. If I go under 25% tax route, so, and I don't claim these benefits, so what is my effective ETR? And if I claim all the deductions, so what would be my effective ETR? Well, I'm saying, like, if you start a new plant now, say you have windows open till 2024 SEZs, and northeast regions like 31st March 2017, you start your manufacturing operations, you get 10 years tax holiday.
That's right.
And for SEZ it is 15 years tax holiday subject to fulfillment of certain conditions. Now, of course, these profits would be subject to MAT, but again in this case also, this 25%, it is again subject to MAT. So I would say this is neutrality. I would rather pick that I am enjoying tax holiday, I would rather go for that rather than going into 25% tax rate. So one has to be very careful and do the cost benefit analysis. What is going to be my tax outflow? And then accordingly take the decision, and that decision you can take if you are corporate SSE. 30th November is the last due date of your filing of tax return. So you can, by that time you are very much aware that should I take 25% tax route or should I take the other route, and decide.
So many of such incentives may not be practical. Of course, appropriate cost benefit analysis needs to be done. Something similar to startup incentives. And Dina, let me ask you this question on startup incentives. And various startup incentives have been provided and proposed. And our dear PM is very bullish and gung-ho about the startup initiatives. Company law relaxations have happened. We've got RBI, we've got income tax amendments. Do you think this is going to help the startup community, or there should have been something more that could have happened?
To my understanding, it's a good initiative. It's a good policy front on the relaxation on certain compliances, and one of the proposals which the FM also made a reference in the budget speech, that they would amend the Companies Act to form a company in one day for a certain startup company. Similarly, there are certain relaxations under the FDI policy on receipt of payment. If certain startup companies have overseas subsidiary, you can actually collect payment in the overseas subsidiary. and then keep that money there for 9 months and then repatriate back to India. And from a budget perspective, they introduce a tax incentive for a startup company, that if you are a startup company which is basically for innovations or for new commercialization of a product, and then if you start between 1st April 2016 to March 2019, then you get 3 years out of 5 years a tax holiday of 100%. But yes, it is subject to a MAT provision. There is also a proposal that if you sell a residential house and you invest into a startup company, and that the startup company makes investments into the plant and machinery, which includes computers and technology related equipments, then also you get a capital gain tax exemption. The only two things which could be improved from a policy perspective, one is for all startup company you need an approval or a recognition from interministerial committee of the Department of Commerce. Now somewhere the overall approach is to reduce going to the government for approvals. Ultimately when you go to interministerial committee, they will find 10 questions and ultimately you will waste 6 to 8 months or 1 year only on getting an approval from an interministerial. So out of 5 years you waste 1 year only in approval process. And then ultimately after 9 months you do not know that whether you will actually get an approval or not. So if certain broad parameters and certain conditions can be laid down, and if the approval can be avoided from an interministerial committee, that would actually have a better fillip and push to the startup business. The second concern is on the turnover criteria, that under the proposed section there is a limitation on which you cannot have a turnover beyond 25 crores in 5 years period. Coincidentally, because of some lacuna in the drafting, if you cross 5 years turnover in the 4th year, there is no mechanism to withdraw incentive which you have already claimed in year 3. That may be more of a drafting error which I believe should be get corrected while passing the Finance Act. But the question is that I want to push a new startup company, I want to push innovations, but at the same time I want to restrict on a turnover. Turnover, that too only 25 crore in a today's time. So my personal gut feeling would be that either our turnover should be increased reasonably, maybe to 100 crores or 200 crore, or the turnover limit should be avoided so that ultimately you actually get a push and a fillip to a startup business. And a third front, that we have a separate section which the Somil will refer on a patent, but somewhere the government of India wants to push on innovations and commercialization of product, because if you go to economic survey, the R&D expenditure from an India perspective is as low as 4 to 5%, which is substantial amount in the large developed or developing economies or even emerging economies. So how do you push the research and development and the investment into research and development by the Indian corporates? Because somewhere that phasing out of incentive on R&D is actually contradictory, or it is in cross connection with the objective which the government is trying to support industry on innovations and research and development.
Yeah. So I'll come back on the research and development point, but Mr. Khaitan, you want to add something?
Acha, the government has introduced a window of 5 years within which you have to claim deduction in 3 years. And it has to be consecutive. And then they have laid down the limit on the turnover is 25 crores.
Yeah.
Now in most of the startup companies, what happens that they are very capital incentive and they need a lot of gestation period. So that 5-year window may not be adequate for claiming the tax deduction. And supposing I take deduction in year 3rd, my turnover is say 20 crores. Year 4th, my turnover is 25 crores. And year 5th, my turnover becomes 27 crores. I don't get the deduction for the 3rd year, but what happens to my 2nd and 3rd year? The law as it is drafted, the assessing officer will have power to reopen the past concluded assessments and deny the benefit for the 3rd and 4th year also. So that lacuna in the Act drafting should be corrected, should be adequately modified. In the year in which I breach that turnover limit, that year alone should be caught hold of, or otherwise the prior year should not be. And then the 25 years turnover is a peanut. Now looking at to the economies of
Yeah.
scale, and so it should be adequately enhanced to at least what he has said, Mr. Shah said, should be at least 200 crores or more.
And just to add to that, a lot of these startups would obviously be loss-making companies in the first 3 or 5 years, in fact. And perhaps one of the other provisions that can be introduced is to relax the provisions of Section 79, which pertains to change in shareholding. And a lot of these startups, the founder or the promoter would have less than 20%, 25%, because they would dilute their shareholding as they are in requirement of more and more funds. So that loss should be protected from the application of Section 79, and that could be one added advantage and benefit that can be offered to the startup community, just in line with the program. So the interesting point, Dinal, that you made is about the R&D benefits. Manish, I'd like to ask you, what will it take? You represent Johnson & Johnson, and what will it take an MNC to invest in R&D facilities in India, 5%, 7% of the turnover spend that they do globally, and discover and develop drugs in India?
So thanks Soumil, and good afternoon all. With your concurrence, I would probably give a much larger and bigger canvas than only pharma. Now, it's interesting that if you look at any big world-renowned organization worth its size and valuation, and you look at as to what is the success mantra of that organization, I think at the center stage you will find innovation, whether it be a product innovation or go-to-market innovation or supply chain innovation, and it will be disruptive and it will be a continuous innovation which will be there. So from that perspective, if you look at, obviously innovation alone will not help. There's going to be a scale up, there's going to be a local brand creation, there is to be taking it to various continents and then creating a global brand out of it. When in an economy such large, big, innovative organization will thrive is when the economy of the country is going to probably go to the next level, and that is the only sustainable way in which a country can technically grow. I would like to probably draw an analogy from a country which is South Korea. South Korea, which is around 4 decades back, was probably in the same situation or maybe a worse situation than India in terms of where it was, with a dense population, limited land, no resources. And what they've done is they've kind of adopted a very rigorous education and a skill development program. At the same time, government actually helped create that economic policy and tax reforms for the innovation in South Korea to thrive. And the private sector actually took up the challenge. And whether now you name, whether it be consumer goods industry or electronics industry or vehicle industry or steel industry, you will see big global giants from South Korea coming up and creating a world-renowned brand from itself. You name currently Samsung, LG, Hyundai, Kia, POSCO. For an economy of South Korea, I mean, there are too big from a global perspective, which has actually helped South Korea take its per capita income from $3,000 to $4,000 4 decades back to $35,000 to $40,000 as it stands today. Now, according to me, that is the need of an hour for India at this point in time. And if I have to see that where I want my country to kind of go to the next level, I want, looking at our size and scale, 25, 50 such big, large, innovative organization which continuously thrives on innovation kind of go to that particular level. Now let me link that pre-context with the budget. And let's see as to what budget has to offer to us and what is government's intent. From last 2 years, we are seeing education and skill development is at forefront, whether you hear Mr. Prime Minister Narendra Modi, whether you see here Ms. Sitaraman, Commerce Ministry, I mean that's at forefront, right? And I think that is the move in the right direction. What is going to be the important thing is the execution, as to how we are able to kind of build that. Make in India is a buzzword, and that will probably help up in the scalability of the entire situation which is there. But I think the next buzzword which is probably going to help is innovate in India. And now if you look at the innovate in India and look at the provisions which are currently there, I completely agree that with the corporate tax rate reduction over a period of time, there is a definite case of reduction or rationalization of incentives and deduction. Having said that, in the light of what I've just shared, is there a case for us to continue the weighted average deduction on R&D as a special case to foster that particular innovation which is there, right? A good start in terms of 10% simple tax rate, which is on the royalty income of patent developed and registered in India. For any organization which is currently not in India, who wants to develop the patent and register in India, they are not only going to look at India alone, they are also going to look at what is going to be the competitive land frame which is available. So in the example that I gave, if you look at South Korea, the current rate of tax is nil for the purpose of royalty income.
Oh, is it?
If you look at the United Kingdom, it is 10% flat but on all profits. And the intent of the government is very clear where they want to foster it. But what confuses is the language which they've used, saying that it is gross royalty income where the expenditure is not going to be allowed. Now what I've heard over last few days is again there is this, the litigative stuff has started as to what will constitute the expenditure or what will not constitute as an expenditure. I would love a simple, clean legislation which tells that, this is the royalty income, our intent is to foster the innovation, and this is the definition of expenditure that we are looking at. And that would really, really help us to get absolutely no litigative legislation which will help foster that. I would also like to bring to notice that it is not only about economic policy and tax reform, it has to be backed by legal framework, right? It is about registration, simplification in patent, and respect of patent and patent protection which is there. I must admit and applaud the government that in last 2 years they have done some tremendous work in terms of tone at the top, in terms of patent protection, in terms of respect for patent. But it is irony in our country that the negative news gets spread and get reported so fast. I would really love government to kind of come and showcase some great work that we have done in last 2 years in sharing these positive aspects in terms of patent protection, which will generate the investor confidence and the organization's confidence, multinational companies' confidence in the country. And with India at heart, I would still feel that we are in the right direction. And I would really like to see some really, really big, innovative global brand created out of India, which are world renowned.
Perhaps change can take a lead
Absolutely.
on that. Interesting observations, Manish. Ramesh bhai, do you think patent box regime is a step in the right direction? Of course, there are many creases to be ironed on the way, but with the likes of patent box regime in the UK or in the Ireland, do you think we can get there, or there is much more to be done?
So patent box regime is a right direction. It follows the BEPS Section 5 nexus approach. India, if you are the innovator, that is, I'm talking about, say, generic research will not qualify for research. So if you are creating new kind of product or innovative molecules or complex research kind of thing, and you are the true and first inventor and you get patented, then you will qualify. The only problem is that they have restricted this deduction to royalty. Whereas if you see Ireland, Luxembourg, and Switzerland now is also coming with patent box regime. They have already introduced in their tax fiscal reform, that is corporate reform 3, and then UK, Netherlands. Now they all say it is not only royalty. Ireland says if it is not a passive income, it's not only a royalty, but any products emanating out of the IP, if they are sold, they are commercialized, still their income would qualify. UK now the tax rate is 18%, it's going to be 17% next year. So again they have patent box, again they have speed up deduction for R&D also. Now this is one part, that you give me the deduction for 10% royalty. I wished that the government is quite pragmatic, that they consider not only the royalty, they consider the product commercialization, profits coming from the product commercialized of IPs. Like there are a lot of litigations also happen in IPs, I know how. And when you settle that litigation, you receive lump sum compensation, and these are very huge. That kind of like infringement or compensation or insurance kind of thing, that should also be exempted. Or they should also be not exempted, they should also be taxed at 10%. So this should be widened. Second thing is the way it is drafted, section 115 BBF. It is going to create a lot of litigations like it has created in the arena of section 14A. Now it says in computing the income, no deduction or allowance will be allowed. Now whether if there is no income, can I still say that no expenditure can be allowed? Now Supreme Court in Hari Prasad's case says income includes loss also. So this is one area of litigation. Second area of litigation, that the expense should be limited to my income or it can exceed my income. And the third area is that if I patent 10 products or 10 IPs, I go and patent them. What happens? Out of 10, I can fail in 9. You know, innovation is a kind, nobody knows what will happen at the end of the tunnel. It's totally dark. And it takes a lot of time. 7 years, 8 years, even 20 years also. So from year 1, when you get it patented, all expenses in relation to that patent research expense gets disallowed. And you do not know what would the fate of my research. So that kind of thing is not visualized, or it is not intended. I think this is probably the drafting error, or there is some mischief in this drafting. I would rather say this way. So we should, like earlier, Netherlands has the patent box, which was subsequently in 2010 substituted with innovation box. Or like UK, they have come out with patent box 2 years back. They said that if the income exceeds the expenses, to that part, only the excess part should be taxed. Ireland taxed me at 6.25%, UK taxes me at 10%, Netherlands at 5%, same way Luxembourg exempts 80%, on 20% they tax 20%, so that is around 5%. Second is that if, again, BEPS, the nexus theory I'm talking, the BEPS is talking that, say, substantial activity, they talk about the substantial activity and the nexus theory. So the research should be carried out in India and it should be registered. If you are outsourcing, you will not get the benefit of patent box. Now supposing substantial activity is taken into India and you source out a part of the activity, can you claim that expenditure or that activity as your under patent box? OECD says yes. I think India will also align, because India is one of the signatories to the OECD BEPS initiative. So India should also agree. I hope they make the necessary amendment in this. With this,
it's a move in the right direction, as you rightly said, supported with the legal framework for protection of patents.
The second thing, that a lot of countries like UK, if you take, or say Switzerland now, they are coming, UK has come out with the patent box. Still they give speed up deduction when you outsource your research, part of the research. And what is happening in our country, that we are paring down the weighted deduction from 200% to 150% and from 1/4/2020 nil. That is 100%, whatever you have incurred you claim. But if you see across the globe, like US is the biggest economy, they give you tax incentive in the form of R&D, that is, you get tax credit, which approximately turns out to be 13 to 14% of your tax. And top of that, if you are a manufacturing company, they give you around, rough calculation, I'm saying it's a very complex calculation, it turns out to be 8 to 10% of the manufacturing profits gets exempt. So we should also move into, because the aim is that we want to attract more and more innovation, we want to make our country self-reliant, more technology savvy, and we want to do the export from India for most of the technologies. Then I think weighted deduction should also be continued. At least if you don't give 200%, at least give it to 150%, because UK also gives you apart from the reduction in tax rate, 125%. Some countries give you the tax credit. So like Switzerland now, they have the tax rate of 8%, apart from cantonal tax rates. So which roughly comes to 12%. Still they are coming out with patent box and then speed up deduction for resource known as research outsourced. So it's a move in right direction, but there's nothing, lot more to do.
Very well.
Can I just add something? While you say that the weighted average reduction should be at least 125, I would actually put it other way around.
No, 150%.
150%. I would actually put that we should actually continue with 200% and actually incentivize the industry furthermore, because if this is what you want to kind of foster in terms of innovation, there can be other ways in which you can decide that, okay, if you do a 200% reduction, you must invest whatever you have said in further innovation. There could be.
Now, what Mr. Bora I'm saying, supposing our tax rate comes down to 25%,
okay,
inclusive of all sales, surcharge, etc. I'm saying we
that
bring
scenario.
it down to 25%. You bring it down the weighted deduction to 150%. Don't take it away completely. And then you make necessary amendments in the existing draft provision, which is 115 BBF, and you clarify that in the year in which the IP becomes successful, in that year you plow back, either you plow back your expense, because you are taxing me on the gross income.
Correct.
So that means my expense will not be allowed. So in the year in which it becomes successful, you plow back the expense, whatever expense has been incurred for bringing that process or product or innovation to the successful stage, you disallow. That's fair enough, because every country does that. But if I am doing the research, I do not know the outcome of the result, and then you are saying I will disqualify the expense. That is too much. That is too much.
Message is clear that the benefit should be extended.
It is not in line with the intent.
Yeah.
So let's move on. It's a nice feeling to get a tax refund in your hand, unless and until you realize that it was your money in the first place.
What is paid is gone.
But the compliance provisions, and there are very positives in this budget in terms of time-bound refunds or the interest that need to be paid for delayed refunds, etc. But at the same time, there are stricter compliance provisions and at the same time, penalty provisions. Sir, I'd like to ask you questions on the penalty provisions. There is scope for interpretation, but your view on whether the penalty provisions are mandatory, discretionary, or it is still open to litigation?
Penalty provisions are by their very nature discretionary, because otherwise that would be interest which would be automatically levied. And since our economy is moving towards from being a command economy to a regulatory economy, we have to have such kind of disincentives, because suppose 99% of returns are being accepted as such. So if we don't have penalty provisions in place, then people will simply evade the taxes.
Agreed.
And I'll want to give you an overview of why this change has come about. This has come about because earlier the penalty was leviable up to 300%, plus you have paid the taxes, that is around 33-34%. So you would end up by paying 123-24%. So courts saw it as expropriatory. So the result was that the tribunal knocked off all the penalties, because it thought that it was being unjust, that someone was being asked to pay much in excess of his income. So that's why they have now been simplified, and there are only two rates, 50% for underreporting and 200% for misreporting. And these are fixed rates. Earlier it was from 100 to 300, you could levy 150, 200, 225 or whatever suited the occasion. It was good in the sense that you can correlate it with the criminality or whatever you call such evasion. But on the other hand, it was totally discretionary, like I may think that you have committed a grave default, but you yourself would think that it's something which you did during the course of business. So in this way, this never stood the test of appeal. If you want something more, then the High Court has held that in suppose there was an addition and the quantum appeal was admitted before the High Court, then the High Court would say that it is not free from doubt, so no penalty can be levied. Now in this situation, underreporting would cover many cases. Suppose depreciation is allowable at say 50%, you claim 60%, then also underreporting would come in. So in a sense, it has simplified things to a great extent, and it is a step in the right direction, because such things should not take much of our time, like taking an issue threadbare and trying to see how much penalty you deserve. So it is now somewhat automatic. Suppose there is some misreporting, some underreporting, then you will have to pay 50%. Misreporting, I have some doubts, because what would constitute misreporting would also be open to many interpretations. But it is a step in the right direction, and I suppose now the penalty regime would be much more effective.
Interesting. At least the penalty has been brought down from 300% to either 50% or 200%. And I hope that the bona fides of the assessees in filing in what their claim was the actual tax return is accepted, or that explanation is accepted by the tax officer, while a lot of discretion is otherwise taken away from the revenue department. So, any other comments by the panelists on the penalty provisions, sir?
It's a good book, but again I would say that rather than introducing a new section 270A, they should have tweaked around the section 271, which speaks of the penalty. And starting from Sadilal Sugar's case and Prince Anwar Shah, Supreme Court now till Reliance Petrochemicals, it is more or less now penalty provisions were settled. The only point of discretion was it is 100 between 100% and 300%. Now the way this section starts, now there were some fundamental protections were given to the assessee, that if you have committed an error because of the wrong judgment or wrong advice, legal advice, or under bona fide belief, then there was no penalty. And this is well settled law. Now there are two situations only. One is underreporting and the second is misreporting. And they have given some examples. What is misreporting, what is underreporting. Yeah. So again, on any addition, whatever addition happens, say between the reported income and the assessed income, there is going to be penalty levy. Assessing officer will levy the penalty. And according to me, I will not be surprised at the way department is functions nowadays, sir. With your, I don't have any grudge against the department, but most of the cases will happen like that. They will be levying 200% penalty. In each and every addition, they will say it is underreport.
At least that 300.
No, underreporting is 50%.
But I'm saying misreport. Now, sir, I have come across very few cases where the tax officers have levied 300% penalty. If it had been very extreme cases, I have never come across except one or two cases where 300% penalty has been levied so far in my 25 years of career in tax. But now 100%, I take this way, 100% has been increased to 200%. Otherwise, I would have been.
Let's give the benefit of doubt to the revenue.
Many of us are lawyers, so whatever has been settled by in Supreme Court in last 40 years, again the battle will start for all of us.
No, why I'm saying, why we bring into a new section when the old section itself takes care of what is your concealment.
But
what
they've
is
also made an
publishing of
attempt to
income.
define what is underreporting and what is.
No, they have defined, but again, there will be lot of attempts will be made by some over enthusiastic officers that it is not
very well.
It is misreporting of the income, not underreporting of income.
So we hear you, Mr. Khaitan.
Yeah.
Dina, let me ask you a very important question about impact of dividend tax on the shareholders in excess of 10 lakhs. This is in line with the government's direction to continue to tax the super rich. And what do you feel this will lead to?
So the words used in the budget documents is vertical inequity. So they wanted to reduce vertical inequity, and that's a reason given in the budget document about introduction of this new tax. So as the law stands at the draft bill, any individual HUF or a firm which includes an LLP, if you receive a dividend in excess of 10 lakhs from a company, it does not include mutual funds, it does not include any other fund, it only includes a domestic company. And if you receive a dividend in excess of rupees 10 lakhs, then in addition to your normal tax bracket, normal rate of taxation, you will pay 10% on the gross amount on rupees 10 lakhs. Now the interpretation issue which is flowing around in the market is that do I pay 10% on the dividend amount in excess of 10 lakhs or I pay on the gross amount including rupees 10 lakhs. So if I take an example, if I receive 11 lakhs of dividend, do I pay 10% on 1 lakh of rupee or do I pay 10% on 11 lakhs of rupee? Now as the draft bill, the two language which is used in the section which use that such income which is exceeds 10 lakhs, and if you go to a memorandum explaining provisions, there the language is in excess of rupees 10 lakhs. So from both these language in the document, somewhere the feeling is coming that the government wanted to tax only amount in excess of rupees 10 lakhs, and therefore if I receive 11 lakhs I should be taxed only on 1 lakh of rupee and not on the 10 lakhs. But let's see what happens ultimately in the final documents. My personal belief would be that even if I want to achieve an objective of vertical inequity, I would have preferred to go back to a pre-98 position to bring back to that the dividend is taxable in the hands of the shareholder rather than in the hands of the company. Because today, if I hold shares of a company or an individual or a firm, I first pay 34% corporate tax, then I pay 20% dividend distribution tax on the balance. So effectively, it will be around 14 to 15% on the balance profit. And then again, if I pay 10%, the rate of taxation is substantially high, ultimately in the hands of a shareholder. And therefore, somewhere my personal belief would be that even if I want to achieve this objective, and we had a similar provisions pre-98, when the shareholder was paying a dividend and we had a section for TDS on the dividend, and maybe some exemption could have been given to a small shareholders from a dividend requirement. The second issue is about the same thing which Mr. Ramesh earlier said on the patent about that no expenditure will be allowed. Now again we had a similar provisions under 14A that if you have an exempt income, no expenditure will be allowed. Now this 10 lakhs is taxable. Now if you make an income as taxable, what is the rationale of not giving you a deduction of an expenditure if you have borrowed money for the purpose of investment in shares? So somewhere again there is a disconnect between the principles. One argument could be that when you are taxing on a gross amount, no expenditure should be deduction. If you are taxing at 30%, you grant a deduction. But somewhere again there is a disconnect in the taxing the income versus the granted the deduction of an expenditure which you incur for the purpose of earning this income. So my personal suggestion would be slightly different.
And I was quite surprised with the enthusiasm of some of the press reports that followed after this tax in the newspapers about who will be impacted the maximum.
And if I just add,
I hope they have brought this tax to the promoter companies also, because what is happening that lot of money is coming in the form of dividend is sitting idle in promoter companies, which is never distributed, and there earlier, if you see, there was section 104, dividend, tax on undistributed profits. They should have either covered promoter companies by introducing again kind of section 104. If you don't distribute, then pay tax on that also.
So we'll have to ask the promoters on that.
Yeah.
But quickly now, we only have 11 minutes to go, and I still have two more important topics. Manish, quickly in 2 minutes, if you could summarize the impact of C/C reportings, to J&J India, and more important, you are a subsidiary of a foreign parent, and how would it impact C/C reporting? Sir, followed with your comments for 2 minutes on C/C reporting for you as an Indian multinational.
Sure. So, I would probably put MNC as a whole. And I think it is a good move and a welcome move that the current country-by-country reporting are in line with the OECD WIPS guidelines which are there, especially in the threshold limit and the reporting requirements. Based upon what is shared in the memorandum, I will be surprised if the master file requirement are also not in line with the international standard requirement. I would rather feel that they will be in line with the international standard requirement which will be there. Obviously, Action 13 lays down the transfer pricing documentation requirements. At this point in time, I don't think so, while this is applicable to all multinational companies, and they're at a nation stage. So many countries who have already adopted this, they have given 1 year of time frame for the purpose of report filing, and I would actually request government to probably give us similar time frame in India. As far as multinational companies are concerned, whether it be for J&J or other multinational companies that I speak to, for us, obviously the parent who is going to kind of prepare the entire master file, because it is for all countries across the world, and they are at a pretty advanced stage of creating that master file.
They are already
creating that master file, at least based upon the information that I have within, and speaking to my colleagues in other multinational companies, they are already on the way forward for that, and it's a welcome move, and I think in a positive direction.
Perfect. Rameshji?
I would rather say that it's a well move because BEPS Initiative 13 wanted more and more transparency. So this will, of course, put more pressure and additional compliances on the taxpayer. But again, cash box type of companies or post box of companies where huge IPs are sheltered and then you claim deduction without any substance or economic activity, and you siphon off your profits and the profits don't get tax at all, then it's a good move. Now we have kept the limit 750 million, that is 5392 crores. And I would rather say this way, and the provisions will apply in reference to my previous year's gross revenues.
Consolidated.
Group's consolidated revenues. So supposing in March 2016, my consolidated revenue of the group is below 750 million. And though it exceeds 750 million in March 17, then for that year my CBC report will, this new report
Those are
will
some of the
apply.
transition matters.
These are and then every year you have to take the prevailing rate. Now that has not been defined, what will the prevailing rate. So now there will be a three-tier approach. One is that master file, local file, there is no change. Master file, again, they have brought the overview of the company's business, then allocation of revenues and costs, and then the global transfer pricing policy. So now you have what happened before this filing, that each location, company used to have different transfer pricing policies. Now you have to maintain a uniform transfer pricing policy. And second thing, if you have to maintain the CBC, which will be high level document, which will include your gross revenues, profit or loss, taxes paid, taxes accrued,
activities
undertaken, and then the number of employees, and then your tangibles, excluding cash. So this will give a high level kind of information to the tax officer, who will immediately, because you have to, this CBC has not been no guidelines, no format has been prescribed, but the memorandum says that we will be in line with that.
With the OECD.
And second thing is that it has not come in section 92D. It has come somewhere in section 281, and then they have not adequately modified master file, etc. They have not reported in section 92D. It is only in the finance minister's speech. So CBC reporting again, if the tax officer is not, he wants to have more additional information, he can call upon the taxpayer to give. So it's a good move, I would say. Now gone are the days when the company used to have say tax companies in the tax haven. So they started with, okay, there are directors and directors are taking the decisions, so income that it belongs to that company.
And that will also test the POEM principles.
Then came the significant people function test.
Sure.
As we call SPT, ST, SFT, then it came then BEPS. So now under BEPS you have to be really, your transaction can be rewritten or agreement can be rewritten if the substance does not show the true intent of the transactions. So
very well. I have one more question for Mr. Saxena before I open the questions for the audience. So be prepared. So no tax is good tax. Call it Google tax or call it humanitarian tax or an exit tax. How do you justify equalization levy?
There is a constant tug of war going on about what is P, what is not P, and there are some businesses which are doing significant sales, significant activities in India, and they have got no PE here. So in that way, it is required, because now really speaking, with the good connectivity, you really don't require a PE. If you go to a good site, you can see a product in all its dimensions, and if a company is reliable, then you can be sure that what they are saying is correct. So they can carry on business in India without having a PE. So it is justified to that extent. But on the other hand, we are moving towards a very high cost economy. Now taxes, indirect taxes have increased a lot, as I said earlier, which may not be good for India as a country, because we have to be competitive in the world. And secondly, all the stated objectives of being good to farmers and all, if we are so high cost, then probably we won't be able to take care of them. So it's not a unmixed blessing, I'll say, but in the circumstances it is required.
Right. And this cost and high cost and inflation is only going to increase if we have the GST roadmap, which converges the tax rate to anywhere between 16 and 18%. So
15 based upon what Honorable Minister said.
Let's hope so.
No, but once GST comes in, tax at least go up by 50%.
Sure. But there will be some time period for it to happen. And until that, at least the first 2 years, at least the survey says that the inflation will increase.
Glitches will also be there.
Glitches also will be there. Thank you so much. The floor is open for questions. We have around 3.5 minutes. Yes, sir. Can we have the mic, please?
Saxena sir, this question is for you. We find that there are those typical officers who are more litigant than assessees. So while the finance minister is trying to address this issue of taking the matter from one court to a higher court and then to a higher court or the tribunal, can there be some sort of a record of an officer? कितने केस फाइल किए, कितने केस हारे, कितने केस री-अपील किए? I'm asking this more on a record keeping, because the government is becoming more and more compliant, is trying to ensure that litigation reduces. Your comment, sir.
Actually, in the government, litigation is a very complex process. It is not for any individual officer to start a litigation. the AO proposes the litigation, then it goes to the range head, then it goes to the commissioner, then there is a committee of chief commissioners which approves the litigation. So if you look at it in that way, then the officer is a very small part of the process, because anyone can overrule him. So to hold some officer responsible for litigation which is being carried out would not be just, because it has been approved by his seniors at least 4 levels.
But see, if I just add on that, the circular of the government in November not to file appeal up to tribunal up to 10 lakhs of tax impact and 20 lakhs to High Court, that too with retrospective impact. It's a huge step. There is some calculations are that it is almost 1,000 crore of revenue which government decided to forgo. It's a huge step.
Yeah. Good afternoon, everyone. Sir, just wanted to know the views on GST, as in if you see the GST framework, it's mostly the IGST, CGST, SGST. So basically the framework remains the same which was earlier. So we can say it's mostly the old wine in new bottle kind of framework, first question. And secondly, about the rates on GST, as in from a manufacturer point of view, maybe the proposed say 18% rate which the committee has suggested is maybe okay, considering excise and VAT in a combination of that. But for service tax, the present rates are 14.5%, and we may propose a 18% rate. So that increase substantially would be borne by consumers. So your views on that? Thank you.
Would you like to comment on that, or?
I think. Okay. So I am not an expert on indirect tax, but let me make an effort. You are right that on IGST, CGST, it's a old wine in a new bottle. But somewhere in a country like India, where you have a state and a center, and our model is exactly similar to Canadian model. And in Canada also, you have a state, you have a central and a federalistic country. And therefore, somewhere to balance this was a reasonably better model to start with. And then over a period of 3-4 years, ultimately you achieve something, particularly in a large democracy where you have a diversity on political angles, diversity on different issues. So you are right, but somewhere it was a reasonably good beginning to start with. There are certain issues on business processes, there are certain issues on cash flows and distribution, supply chain. To my understanding, the industry has represented it, and somewhere it should get corrected. On the rate, as I see the economics and what Arvind Subramaniam said, today the collection of the taxes on indirect tax front, which is approximately 10 to 12% of the GDP, which accounts to around 55,000 crores of rupees. Now if I take that factor, then my ideal rate of tax should not exceed 8 to 10% on the present level. But yes, there are certain commodities where you need relaxation in each state, and therefore to balance out, there was a discussion that it would be anything between 12 to 18%. And my personal gut feeling both from the media and from the discussion, it should be stable around 15%. That may be one of the reasons, I am not sure, that the service tax has been increased by 0.5%, maybe in the name of a surcharge, ultimately to peg at 15%.
Can I add something?
Please.
Just one point, that it is not only about the legislation, it is also about the fungibility of the credit. And if you look at this point in time, the fungibility of credit is not there. If you look at, it is so complex. Our environment is in terms of indirect tax, you have excise, you have CVD, you have octroi, you have so many other taxes which are there. All of them are getting subsumed under one tax, which will be same all the states. So look at from a compliance perspective, look at from the legislative ease perspective, it will really help. At the same time, since the input credit will be available at every stage, ultimately in whichever country the GST has been implemented, the idea is initial period of 12 to 18 months you will find that it will be inflationary, but then ultimately inflation would come down and the consumer is going to benefit as the companies start passing on the benefits of what they are getting to the ultimate consumer, especially because of the competitive environment that will prevail. So not necessarily that it will have the same impact it is today. It will definitely be positive over a period of 18 to 24 months time frame. Initial time frame to expect it to be straightway helping consumers will be very, very tough, because initial phase it will definitely be inflationary, but then hopefully the inflation would come down and consumers would ultimately win in majority of the industries, except for those industries where currently there are inverted duty structures, and how that will play we will have to see.
So the Tigger is already showing a red face. Last question.
Thank you, sir. Hello. Sir, basically I have a question with Mr. Saxena ji, who is the Chief Commissioner of Income Tax, respected. Sir, I have a problem with the drafting language of Income Tax Act since very beginning, and also the value of money from the point of view of government and from the point of view of a common man. The first one is section 220 bracket 2. 1% per annum interest will be imposed on the SSE if he failed to pay the tax within 1 month of receiving the demand notice under section 156. Okay, so 1% will be imposed on them. But when we received any favorable order from CIT or tribunal, the department takes n number of years to give the effect. And now the department has awakened and given the additional 3% per annum interest for the delay, that is also beyond 3 months. So this seems very negligible. That is my first question. And second, whenever the government, the Income Tax Act provides any benefit to the SSE, they use the phrase whichever is lower. And whenever they charge us, they say whichever is higher. Why such difference?
Let me answer that question for Mr. Saxena. Not that he also likes any litigation. He also is the bearer of the same agony that all of us are. So he cannot be blamed for bad drafting out here. So we hear you. And I think we'll conclude this session with just last question. And quickly, Ramesh ji, should the budget be an annual event or a 2-year event?
I think as most of the economies you see, the finance budgets are finance bill every year comes. So I think it's okay if it is annual event.
Not the US though. Manish?
While I agree that US it is not, but I would probably have a policy framework which has been given for 5 years, and then every year budget would just come and give the actionable items which would help get that predictability out of what is likely to come out of the budget, and hopefully make a budget a non-event, which is still not been done.
Dinan?
Yeah, I would agree that it should be not an event, and I think what Manish said, that process has started. Phasing out of incentives almost up to 31st March 2020. Some roadmap has been given. Let's see how far government is able to achieve this and ultimately implement.
Sir?
If you see the amendments, we have 109 amendments this time. So that would answer your question. What I'll say is that the rates etc. should be in the Income Tax Act. They should not be in the budget, because people should have some kind of certainty that their income is to be taxed at this rate. So that should be not form part of the budget, but if the government has to make so many changes, so in 2 years they'll make 218 changes. So we should have it annually.
And we don't want to steal the thunder out of Finance Minister's Day. Sir, last question for you. We've always heard about industry's representation on what their expectations are from the budget, but we've never heard revenues expectations from the budget. Would you like to quickly, in a minute's time, talk about what would be generally revenues expectations or misses from a revenues perspective in this budget?
What I'll say is that there is a process of consultation with us before the budget is finalized, but sometimes very, very important and long-term changes are being brought in, and they should be debated, if not with us, with the public, like the VDIS scheme in another name is there, then the Kar Vivad Samadhan scheme in another name is there. So they are very major steps. They should at least be discussed to that extent. To that extent, there should not be so much secrecy about the budget that its provisions are not to be revealed in any way. All the people who formulate the budget are kept under imprisonment and so on. So this is what I like to say, that it should be a very open process so that we also know how the public is going to take the changes. And
interesting,
yeah.
very nice, very important, sir. I'm sure there are many other points to be discussed, but given the time constraint that we have, I'd like to thank my co-speakers and the panelists out here. Thank you so much.
Thank you. Thank you.
Let's have a huge round of applause one more time. A very, very interesting session indeed, and we managed to extract some good questions from the audience as well. But on that note, I'd like to invite Mr. Dharmesh from Times Conferences Limited to please come forward and present the mementos to all of our speakers to thank them as well. Thank you once again, gentlemen. I'm going to request you to also come forward for a group photograph as well. So we managed to get some food for thought from all of our speakers. It's that time of the hour when your thoughts are on food. So we're going to be now heading for a lunch break, and the scheduled break is still about 2:30. So 2:30 p.m. we're going to resume with our very, very important keynote address as well. I'm going to request all of you to please proceed to the pre-function area and also connect with our speakers in case of further queries. See you all at 2:30 p.m. for our keynote address. Thank you. Address. But before we do that, if I may request all the ones who are seated right behind, if you may please step forward and take your seats ahead. We've got a couple of vacant seats right ahead, so you may please grab them as well. I'm going to request all those who are seated right behind. We're going to get started with the keynote address by Mr. Ajit Ranade in a short while. We have the presence of Dr. Ajit Ranade, who's a senior president and chief economist at Aditya Birla Group. In fact, he's a man with many noteworthy credentials, also being the executive officer of Financial Technologies India Limited, and has also served as a chief economist at ABN AMRO Bank, and also serves as a director on board of Hindalco Almex Aerospace Limited, a joint venture company of the Hindalco and Almex Incorporates of USA. So this afternoon, we're about to receive perspectives and insights from the very own Dr. Ajit Ranade. So can we have an enthusiastic round of applause to welcome our speaker, Dr. Ranade.
Thank you, Kavya. Thank you. Good afternoon, friends. So this is one more day of one more session of discussing the budget. Thank you for inviting me, Vidya and your colleagues. So I know it's a post-lunch session. I hope you had some coffee to stimulate, like the budget stimulated us. Now I know that it's been 10 days now. Today is what, 9th of March? 10th, sorry. So it's been 10 days since the budget was presented. So what I propose to do is talk about a few things which I found somewhat interesting or good or bad or objectionable or wonderful. So let me make a presentation that way. And maybe with the permission of Vidya, we can have some time for a question and answers discussion. So that way I think we can make it more effective. So let me just quickly begin. You see, the background of the budget is the following, that we have after a long time, after almost 30 years, we have a government where the main ruling party has more than 283 members of parliament, right? And the NDA together I think has 300 plus members. The way the budget is presented, technically the budget is a proposal. That is, it's a proposal of spending and how that spending is going to be financed in the next 1 year. It's a proposal. Not even a single rupee can be spent by the government of India without the consent of Parliament. That's the rule, that's the constitutional provision. So therefore a finance bill has to be tabled and has to be approved by Parliament. Then from 1st of April onwards in the next financial year, the government can spend money. Yeah. But this time, unlike the previous governments, in fact, like I said, first time after a long time of 30 years gap, first time we have had a situation where in fact the ruling party has 283 members. So agar unko chahiye, so they can just present a proposal, a budget plan, and it can get approved just like that. Even if everybody else in Parliament decides to oppose it, it will just get passed by majority because that's how the voting happens. And in fact, we have a whip system, right? So surely it's a cakewalk. Jo bhi aap propose kijiye, it will be passed. And unlike other bills, such as let's say the GST bill or many other bills, unlike other legislations in Parliament, the finance bill does not need the blessings or does not need the passage in Rajya Sabha, which is where the ruling party has some difficulty. So the way the constitutional provision is that the budget proposal can perhaps be, the Rajya Sabha can perhaps raise some questions, some objections and ask for some reconsiderations, but they can send it back to Lok Sabha, and there might be a discussion, perhaps some revision, but Rajya Sabha cannot block the passage of the finance bill. So that is the background. If aisa hai, then why, how come, then there's no problem, just we can go full guns with bold things, bold decisions, bold proposals, right? That's not the case. Why? Because even though you have a whip system, even though the ruling party can just completely, and perhaps that is the reason why there's such a lot of expectation that this time the budget is going to be full of fantastic reforms, some radical revolutionary decisions, and some papers you must have read this. But aisa nahi hai. Kyun? Because after all, each member of the ruling party, also member of parliament, is answerable to their own constituency. And so therefore, whatever proposals that come finally in the form of a budget, these proposals represent some kind of a consensus. These represent some kind of a consensus. And this has to be a consensus which is acceptable to the voters, which is acceptable to taxpayers, which is acceptable to citizens of India. So even if you have what they call left-wing government, right-wing government, centrist government, the fact is that India's policies and whether it's budgets or economic policy in general have a tremendous sense of continuity. If you look back last 25 years, they are going in a particular direction. Maybe sometimes the speed is fast, sometimes the speed is slow, and by and large, it's a direction that has been kept consistent by various governments. We've had we have had several different governments in the last 25 years. So that's one thing I want to say up front, that even though with an absolute majority in Lok Sabha, you still need to have a budget which has which reflects the consensus thinking about the economy and about economic reforms. Okay, that's one. Second point is that the backdrop of this budget was there were two big problems in the economy. One bigger problem was the problems in agriculture and the rural economy. The stories of agriculture distress, the fact that for 2 consecutive years we've had a situation, we've had real wages stagnating in agriculture, we've had commodity prices falling, you had rural incomes, rural purchasing power not doing so well. That's a big story. That was one big backdrop. The other big backdrop was the problems with the banking sector. Slowly, the news of the various NPAs. Today is not the time to discuss wo kyun hua, but the fact is that the NPA level is now reached 5.1% and perhaps will go higher. And repeatedly the Reserve Bank of India and various other people have been saying, even though the NPAs are confined to about 5-6 sectors, real estate, infrastructure, and so on, steel. So that was the other big backdrop. So surely the budget, there's expectation that it's going to address these two for sure. So that's the backdrop, okay? That number one, you still need to have a consensus, reflecting a consensus view. Secondly, the address the rural situation, rural distress. Thirdly, take cognizance of the banking situation. Having said that, the biggest, of course, headline news from the budget was the fact that the finance minister and the budget proposal has kept 2 fiscal promises. 2 promises have been kept. 1 year ago, the finance minister said that during this next year, we are going to target a fiscal deficit target. We are going to target the fiscal deficit to be 3.9% of GDP. Guess what? At the end of the year, he managed to keep that promise. Second, 12 months ago, the finance minister said, in the subsequent years, we are going to target the deficit to come down to 3.5%. Guess what? The second promise also has been kept. Namely, the budget proposal says that for next year, that is fiscal year 17, the target is going to be 3.5%. So these are two great headline sort of achievements, that 2 fiscal promises have been kept. This is, I think, a very big message from the budget, that whatever the other compulsions, we are going to be very much cognizant of the fiscal deficit situation. And mind you, this was not easy, because there was a lot of pressure from various quarters, from industry chambers, from people in government, including the chief economic advisor, who were saying, "Arey, isme kya, fark padta? 3.5%. Don't be like a fiscal fundamentalist. Don't be like a fiscal hawk. This is a year when we need some stimulus, we need to expand the fiscal deficit, let's go for 3.7%, 3.8%, say 0.23 decimal se kya hota hai, kind of a thing." But actually, it was a great, I think, achievement to stick to that 3.5 number. So I really applaud that. And it's just not just me. You must have seen in the few days after the budget, all 3 markets went up. I don't know what the situation is today, but I think it's positive. So the stock market went up, the bond market went up, the currency market went up, meaning all of them had a pretty strong bullish reaction. And this is unprecedented. I don't think it has happened, at least in recent times. So this, I think the reason for this is that perhaps the expectation is, the reason this kind of reaction we saw is that there is a potential virtuous cycle now which can happen. Namely that with the fiscal situation now being, fiscal deficit being now targeted to the promised number, this leaves room now for the Reserve Bank, let's say, to have a rate cut or, have an aggressive rate cutting stance, which can in turn enthuse investors, especially foreign and domestic investors. And if there is dollar inflow further, that can lead to stabilization or if not strengthening of the rupee, exchange rate, which in turn can again, because it will have some moderating influence on inflation, which in turn can again attract more FDI, more foreign inflows, which can become a virtuous cycle. So inflows, currency strengthening, inflation moderation, more inflows, currencies, that kind of a thing. So this is a potentially virtuous cycle scenario that can happen, and I think we are seeing some of that. Of course, we should not get carried away. There should be not irrational exuberance. In any case, we don't want the rupee to get so strong that we become uncompetitive with our neighbors, especially China. Already the Reserve Bank is telling us that the rupee is somewhat overvalued. According to their calculations, it is 10% overvalued. I'm not so sure because that RER calculation, there are 2-3 ways of looking at it. So we don't want the rupee to be too strong, because already one big point of concern this last 1 year, even though we had, as I said, fiscal deficit promises were kept, current account deficit came down, inflation was moderating, FII inflows were very good, private FDI inflows were record high, $50 billion almost. Private equity inflows into India were fantastic. First time private equity inflows were more than stock market inflows. All that was good. But as I said, apart from the rural distress and the banking problem that I said, another big area of concern was the fact that our exports were not doing well. Exports had contracted by 15% this year, have contracted. And this is again very unusual because India's exports generally have done very well, 10 to 15% growth. Maybe they, sometimes if it's a difficult year, single digit, but negative 15, that's something to be concerned, even though some of it is because of falling commodity prices. So other exports are suffering, then in such a scenario, we don't want the rupee to get too strong, because that will affect our exports adversely. So that is that's the main takeaway, according to me. The fiscal message. That incidentally, the reason the fiscal message is important, I told you, potentially it can lead to this virtuous cycle of inflows, currency strengthening, and more stock market and FDI inflows. But it's also important because internationally, if you look at India's situation and look at how many large countries have a fiscal deficit, combined fiscal deficit ratio of 7%, which means combined matlab states plus center. There are only 2 countries in the world which have this kind of a high deficit, which is India and Brazil. And you know what is happening in Brazil. Brazil is actually, GDP is growing by -3, it is shrinking. Brazil and Russia are 2 large economies, BRIC, remember BRIC, Brazil, Russia, India, China. Usme se Brazil is -5%, Russia is -3 or 5%. So that is not a good example for us at this point. In fact, there was a speech given by the Reserve Bank governor in Delhi, I think last month, where he pointed out the dangers of fiscal stimulus because of, look what happened in Brazil. So this fiscal deficit number is important, and therefore the message that we have given कि हम लोग fiscally disciplined रहेंगे, fiscal prudence, fiscal consolidation, we will stick to this path. These are to be welcomed. So now we of course talk about the rest of the budget story. As I was telling you, that this is this sort of a parliamentary process that kuch bhi karo, the majority has, so we can do a lot of things. That doesn't work because you have to respect the consensus of the electorate. The other big reason that there is limited room to do something is look at the committed expenses. See, this year the finance minister has presented to us a budget which is roughly 20 lakh crores, 20 trillion rupees, which is 1/6 of India's income. 1/6 of India's national income is decided by this one speech or one proposal which the minister of the country stands up in Parliament 29 February and makes a speech at 11 o'clock. 1/6 of national income. That's the big impact. That's the significance of the speech. But there are a lot of expenditures already committed. Commitment. There is no choice, no discretion. Example, interest payment. The largest expenditure commitment is interest payment. I think, I forget what the exact number is, about 4.5, let's say 5 lakh crores. Between 4.5 and 5 lakh crores. So 5 lakh crores, which is 1/4 of your spending, 20 lakh crores is the total budget, 1/4 of that spending is just one single item, interest payment. That interest is paid on this huge mountain of the debt called the sovereign debt, and this interest payment is so therefore when you're deciding the budget for next year, that part is taken away, so you don't have a leeway, no discretion in that part. So you're left with the remaining part. So there are many such items which are non-discretionary. I won't list them here, but so all those commitments on various subsidies, these are all commitments. For example, now the fact is that the Seventh Pay Commission recommendations, those are also, to the extent that the government has accepted them, that also is a commitment now. The OROP kind of, that is another. Then I guess you can say the expenditure on defense, which did not figure in the budget speech at all, that's also a commitment. So if you look at all those parameters, there's not much leeway. I mean, I should say there's limited leeway about how much you can play. So let me just say what were the other highlights, apart from the fiscal, great message of fiscal discipline, what were the other highlights? The other highlights, of course, I must say is that non-budget items, there were a lot of them. I mean, we are still, as I said, only 10 days ago we had the budget speech, but the budget documents are almost like 2,000-3,000 pages. So it takes a lot of time to go through the fine print. But if you look at the non-spending or non-revenue related decisions announced in the speech or as policy, they're all very, very welcome. Such as the Aadhaar bill, which happened right away. Such as the bankruptcy bill, which is going to be tabled. Such as the PPP resolution mechanism through the new commission. So public-private partnership projects, a lot of them have got stuck, mostly because of disputes, because they go to court and they get stuck there. So instead of having fast-track courts or special courts, there's going to be a commission which will look at the possibility of renegotiating some of these contracts. So that also is welcome, because if you unlock and unentangle many of these projects, many of them will again get started. Then there is a lot of stuff related to tax disputes. So PPP disputes ek baat hai. Tax disputes. The total amount of money that's locked up in various tax litigation is, I believe, more than 4 lakh crores. Imagine 4 lakh crores is stuck in litigation, where one party to the litigation is income tax department or tax department, and the other party is the taxpayer. Often the taxpayer also happens to be Government of India enterprises. In fact, I believe a very large part of the disputes are between a government department and the tax department. So there is a lot of fine print there about improving this process of settling the tax disputes or making it easier. So I won't go through that small fine print. I must say also that I actually I have these numbers which, let me just from the budget. This is also a season where in our own companies we are doing budgeting for next year. We are looking at what was the performance for last year, and we usually say what last year, what was the target set by the company, how much did we achieve or overachieve, underachieve, and what are the targets for next year. So if you apply the same kind of thinking to Government of India, last year the revenue deficit was targeted at 2.8% of GDP. The actual performance came out to be 2.5% of GDP. Usse bhi kam aaya, deficit kam aaya. Positive, tick mark. Second, the fiscal deficit, I told you the target was 3.9% of GDP. The actual performance was 3.9% of GDP. Achieved, tick mark. Third, the tax revenue, total tax collection was budgeted to be 9.2 lakh crores, 9.2 trillion rupees. The actual achievement, actual collection on that tax revenue account was 9.48 lakh crores. Achieved, overachieved, tick mark. Fourth, non-tax revenue was budgeted to be 2.21 lakh crores. Actual non-tax collection during the year was 2.59 lakh crores. Achieved, overachieved, tick mark. Recovery of loans. Government of India was planning to recover, according to the last year's budget, 10.7 thousand crores. Actually recovered 18.9 thousand crores. Overachieved, tick mark. Interest paid on the debt. Total interest that was planned to be paid last year as per the budget plan, 5-6 lakh crores. Actual payment, 4.4 lakh crores. 10,000 crores ka savings. Achieved. Tick mark. So, I mean, this is not the kind of thing we are used to in government performance, right? Usually all the numbers, the slippage is in the other direction. You had planned to raise so much of tax revenue, उसमें कम आया. You had planned to raise so much of non-tax revenue, उसमें कम आया. You had planned to recover loans of this much, उससे कम आया. You had planned to make interest payments of so much, उससे ज़्यादा आया. But so I mean, I don't want to bore you with too many details, but this actually shows that on these counts also we should be happy about the budget. So generally, I think there's a lot to comment on the budget, but I will now conclude because I don't want to leave you with the impression that everything is all rosy, hunky-dory. So what are some of the things which I was troubled about? So I was three things, two or three things. One is this whole business of the Cess Raj. So what I call the tyranny of the Cess Raj. So cesses are, so there are three new cesses which came this year. One was the Swachh Bharat cess which came I think in November. Then you have the Krishi Kalyan cess which was announced in the budget, which together effectively makes the service tax rate now at 15%. And then there was this coal cess which was renamed as Swachh Bharat, Swachh Environment cess, Clean Environment cess, Clean Energy or Clean Environment cess. So yes, cess Raj jo hai, there's so many cesses, there's an excess of cess, and it is now the situation is that of the total tax share of the Government of India, so Government of India collects all these taxes from everybody, then it splits. थोड़ा स्टेट्स को जाता है, बाकी स्टेट सेंटर को रहता है. तो ये सेंटर का जो कलेक्शन है, स्टेट सेंटर का जो टैक्स शेयर है, व्हाट परसेंटेज ऑफ दैट कम्स फ्रॉम द सेसेस अलोन? आंसर 20%, 18 point something. So almost 20%, almost 1/5 of your now share of tax revenues is coming from cess. That's not very unhealthy. Point number one. Second point, ये जो clean energy cess है, or what is basically coal cess, has been doubled 3 times in last 3 years. So it started a few years ago, 4-5 years ago at 50 rupees a ton. First time it was introduced. That 50 became 100, 100 became 200, 200 became 400 rupees this year. It's not ad valorem, it's actually a specific duty. Today the cost of mining coal, open cast mining, is about 300 rupees a ton. उसके ऊपर 400 rupees a ton is now the coal, the clean energy cess. You know, the Prime Minister lady in Australia, Mrs. Julia Gillard, when she introduced a mining tax of $25 a ton, she lost her job. She was removed as Prime Minister. United States of America, the biggest economy in the world, did not sign the Kyoto Protocol for clean environment, climate change. We are signatories not only to Kyoto Protocol, before that the Montreal Protocol. We are one of the leaders or take a lot of initiative in climate change initiatives. The Prime Minister of India in 2008 launched the National Action Plan for Climate Change. We are signatories to Paris recently. So it's not as if we are not aware of this challenge of climate change. But I am saying, why should we be holier than thou? As it is, we have been taken to the WTO and getting punished for our solar mission policies by the US. That's a different matter. But why are we trying to be holier than thou? We have the world's third highest coal deposits. And in the near foreseeable future, our electricity is primarily going to come from coal. Look at the health of our DISCOMs. There are 7 lakh crores which are stuck. 7 lakh crores of either bad loans or overdues, so the DISCOMs are struggling, they are struggling to raise tariffs, the electricity prices are going up, and here we are putting extra taxes on coal. Last 8-9 days, we have these people who are sitting on strike, the jewelry workers, jewelry industry, because 1% excise has been introduced on jewelry. But there's not a murmur of protest. I mean, nobody's gone on strike because of the coal cess. There's also 1% excise on clothing above 1,000 rupees. If you're buying a shirt or a suit which is more than 1,000 rupees, there's a excise duty, new excise duty. But that is, so I said these are some of the troubling aspects. I feel that the cesses represent indirect taxes. Indirect tax is a burden which affects everybody, taxpayers and non-taxpayers, in the sense that वो बोलते हैं कि only 3% of India's population pays income tax. But the fact is that everybody pays taxes, because even if you buy a bar of soap or toothpaste, उसमें sales tax रहता है, indirect taxes रहते हैं. So the actual tax burden falls on most of India, and indirect taxes are more regressive because the burden of indirect taxes is disproportionately higher on the poor as compared to non-poor. So generally the direction of India should be towards more direct taxes and less indirect taxes. So all these cesses and all these indirect taxes represent a wrong direction according to me. So those are the nitpicking things I can talk about more, but broadly speaking, the broad, very positive message is that fiscal discipline, fiscal consolidation, good performance and meeting of targets which were promised last year, so adds tremendously to the credibility of the government, and a lot of reforms in the fine print on tax litigation, on various kinds of ease of doing business, and of course sufficient adequate focus on rural economy infrastructure. So, if you give a mic to the economist, he can go on and on. So, but to be fair to you, I'll conclude here. Thank you.
Well, thank you very much, Dr. Ranade. Well, ladies and gentlemen, the floor is open for question and answer session. So, please do raise your hands. We'll have the mic passed on to you. All right, so Ms. Sandhya has a question herself.
Sir, you spoke about the performance initially in the beginning part of your speech, and then you spoke about the cess. And somewhere when you were talking about some numbers, you said that the tax recovery, on the tax recovery front, the government has delivered, rather, overachieved. And then you spoke about the cesses. So is that tax recovery real recovery, or is it because of the cesses?
Yeah, very good question. By the way, the cess is also a tax, huh? It's cess. Thanks for reminding me. So what is wrong with the cess? First of all, the problem is with the cess, it's an indirect tax. Secondly, the cess is not shareable with state governments. So the cess is in principle against the spirit of cooperative federalism. Because normally cooperative federalism that Prime Minister talks a lot about is about sharing of resources. The whole GST bill is actually about sharing and a unified tax regime. But what cesses tend to do is they go in the opposite direction. So actually they are contrary to the spirit of cooperative federalism. So you are right that now indeed the achievements were there on whatever you said, revenue deficit, the fiscal deficit. But how did they achieve that? So your question is, how did they achieve that? One, of course, the huge benefit that we got from the fall in oil prices. Because oil prices fell, a huge amount of oil subsidy savings was there, something like almost 100,000 crores. Not all of it was passed on to the consumers. So if oil prices fell by almost 60 to 70%, your petrol and diesel prices in the petrol pump did not fall by 60-70%. Yeah, they fell only by 20%. So baki ka kahan gaya? Baki ka was taken up by the government. So they used that to shore up their treasury, to shore up the fiscal deficit, to compensate the oil marketing companies, or the upstream companies. So they again, and they, by the way, they also increased excise on petrol and diesel almost 300%. No murmur came on that. So you're right. When you start, so your point was that while the government has indeed overachieved on all its expenditure targets or recovery targets, but the finer point story is that how did they achieve it? They achieved it by various means, including by introducing cesses or by not passing on the benefits of oil price crash. That's true. So with every budget, पहला एकदम सुहावना चमक लगता है. When you start reading, then all the ugly part starts becoming visible. So that's true. Some of the details when you go through, then it becomes, you can question that. But for a discussion like this, I think we must appreciate at least the headline impact of the budget and the main initiatives, the main message that the finance minister is trying to give. They're all positive and reformist.
Good afternoon, sir. Just wanted to know one backdrop that you were talking about initially, about the problem that the metal industry, specifically metal and mining and power sector is facing, but no specific reforms to that, especially adding coal, clean energy cess is a more hit on the power sector per se. So, I mean, no steps taken in that direction or improvement. And secondly, when we are talking about the headlines of government maintaining this 3.9% deficit, but that is at the cost of cess, the ultimate cost being borne by the consumer itself. So, to some extent, not probably a major percentage of it.
Yeah. So, the second part of the question is similar to this lady's question, that basically, how are we achieving this fiscal consolidation? How are we achieving the fiscal targets? Of course, some of it is by introducing new cesses. So it's true, and cesses tend to be indirect taxes. To that extent, they are regressive or somewhat unfair, in the sense that the burden is shared, between relatively well-off people and low-income people. So that's true, and that's something. That's why I cautioned towards the end of my speech. I did say that the government should curb its tendency and hopefully will remove these cesses. They are saying that once the GST comes, all these cesses will go. That's the promise, or that's what was indicated. Your first question about what was done for the spirit of doing something for this sector, that sector, this sector, I think that has gone now. Those were the long ago, in the olden days, the budget used to have something specific for this sector, for something for that sector, that approach I think is gone. I made the point about the coal cess because that affects energy costs of everybody. Electricity, whether it's metals, mining, chemicals, even textiles, all are subject to energy costs. And when we make coal expensive, will be through administered prices. International prices of coal are falling, and we are putting a cess on it. So we are actually making the price of coal in India more expensive than international costs. So we are actually introducing kind of a degree of uncompetitiveness. So I'm cautioning against that.
Sir.
Yeah.
Good afternoon, sir. Whilst we have taken cognizance of the NPA, some of your views about the real extent of the NPA, and the second part of the question is that if we move towards global accounting standard IFRS, which is based on expected credit instead of incurred credit loss, I think we are sitting on a time bomb on NPAs.
Yeah. So NPAs, I told you that of the two serious backdrops to the budget, I told you the two big serious macro issues were the rural economy and banking. So, of course, on banking we had Indra Dhanush, we had one Gyan Sangam 1, Gyan Sangam 2 this year. There's been a lot of deliberation. Mr. Vinod Rai has been appointed as chairman of the banking bureau, the bank board bureau. So there's a lot of thinking going on banking. And what is the exact really estimate of NPAs, how serious it is? The fact is that under this dispensation, both the government and especially the Reserve Bank of India, they are going relentlessly at this problem for last 1 year, more than a year. So they have introduced they're stressing on the CDR, corporate debt restructuring. We have the debt recovery tribunals. Then you have this SDR, the strategic debt, SDR scheme. Then you have the 5/25 scheme. You have, so various things are being worked at. And the fact is that we are reporting 5.1%. I must tell you that in the early 90s, 91, 92 ke time, pehli baar when NPA recognition was adopted in this country, that was the first time. The NPAs were some 17 or 18%. From those days, we have come down to, we came actually down to 2.5%, and now it's gone up again to 5%. So it's 5% is pretty serious, but let's recognize our own history and our achievements in the last 25 years. And just by way of reference, the official number for Chinese NPA is 2%. Nobody believes not many people believe that number. Ernst & Young का एक report आया था कि उनका NPA is 40%, 40. So this is a problem affecting various countries, and the fact is, as a consequence of QE and expansion of bank balance sheets, the NPA problem has become serious. There was a sovereign debt crisis in Europe. Now this is the private debt crisis. I wouldn't call it a crisis, but I think it's a serious challenge, and the sooner we resolve it. So we also, by the way, I forgot to mention that we not only had recapitalization of 25,000 crores, which is the first installment, but we also had the ARC, the bad bank, creation of the bad bank. And the sooner we get to IFRS, then this is all about accounting norms. I know a lot of people probably are CAs here, so you have to recognize, you can't count your chicken before the egg hatches. But the accountants ulte karte hain. So you even after the egg and chicken has come, they don't want you to count it. And on the other hand, losses होंगे तो आज के आज आपको recognize. So those kind of strict norms we are trying to get there. That's what the spirit of IFRS is. I think it's scheduled for next year or 2 years from now.
For the banking sector, it's still deferred.
Deferred, yeah, 2019.
I have another part of the question is that,
Yeah.
see, whilst we talk about ease of doing business and startup and make in India and all that, but because of the banking sector problem, many of the eligible, honest people who deserve to get credit are not getting credit. So there's something to think about.
Yeah, so NPA, no, exactly. So NPA problem is not only the problem of recovery, the NPA problem is the problem of credit delivery to the deserving. Because this problem is locked up here, the legitimate guys are denied credit. Same thing like fiscal deficit. If the biggest borrower in the system is Government of India, they borrow 5 lakh crores every year. So itna bada elephant rahega, so they just crowd out all the legitimate borrowers. So when I said fiscal deficit, fiscal responsibility is important, fiscal consolidation, fiscal is important, because if they curb their fiscal deficit, then only there's room for others to borrow. Same thing, just like fiscal deficit is a good news, similarly doing something about bank NPAs is good news, because then it allows the legitimate guys to also become, have access to that credit. Okay, I think, yeah.
Any further questions? One last check.
Last question.
All right, so we'll take one last question from the gentleman.
Sir, by recommending by accepting the recommendation of 7th Pay Commission, what will be the impact of inflation on the economy? And since no tax rate has been changed for individual taxpayers, the persons who are not in government service, they are totally ignored. And by not even providing incentive to go for agriculture business as startups, I believe it's not a fair budget.
See, the 7th Pay Commission allotment, I believe, is something like 0.7% of GDP in this budget. What it will do is, because predominantly these 2 crore employees tend to be urban based, it's going to add to the urban purchasing power and urban consumption, and therefore to that extent the urban economy will benefit. Whether it will lead to inflation, I doubt it, because we have been seeing moderation of inflation for the last 2 or 3 years. It used to be 10% for a long, between 2009 and 2013. That 10% has come down to 5 or 4.5% now. And there is a lot of excess capacity in many sectors. So to that extent, while the urban consumption may go up, that will not necessarily contribute to inflation because of the this pay commission bonuses or the awards. As for what happens, first of all, because of the pay commission now, even state government employees will expect that. So next year, I think we are going to see that. As for what happens to the non-government employees, well, the whole idea is that the pay commission is a compensation, because private sector may, at least the organized sector, is supposed to get increments and bonuses and variable pay every year. And after a gap of 10 years, usually there is, the government servants, they feel they fall behind, and the pay commission corrects that gap. So the spirit of pay commission is to bring them up, but you're saying they're going far ahead. So maybe, over next 10 years, ulta ho jayega. So I don't know. I mean, it's true that obviously the pay commission does not apply to non-government employees. All right, thank you again very much. Thank you.
Well, thank you very much, Dr. Ranade. If I may kindly request you to remain on the stage, I'd like to invite Ms. Sandhya Adhar, who is the Sector Head of Times Conferences Limited, to please present a memento as a token of gratitude to Dr. Ranade. And let's have a round of applause one more time, ladies and gentlemen. Thank you very much, sir. Despite it being a post-lunch session, we must admit it was quite an appetizing session indeed. So thank you once again for all those insights. Thank you very much. And with that, ladies and gentlemen, we'd also like to announce that the feedback forms have been distributed to all of you. So please do take your time off to fill in the feedback forms. And with that, we're now about to get started with another round of interaction on the core sectors, expectation versus reality, and also roadmap to reforms. Ladies and gentlemen, I'd like to invite our esteemed set of speakers to please take their seats on the dais. May I please invite Mr. Ashish Singh, Managing Director and Head of India, Principal Finance Real Estate, Standard Chartered Bank, to please come forward. May I also invite CA Atul Gupta, Central Council Member with ICAI, and Mr. Samir Kanabar, who is a tax partner with EY India. Ladies and gentlemen, can we have a round of applause to welcome our final set of speakers as they interact on this very relevant topic that we had just mentioned. Also, ladies and gentlemen, we'd like to also inform to all the members of the audience that as we were awaiting the presence of our Minister, Honorable Minister Shri Sudhir Mungantiwar, now as he's happened to be as a part of the assembly proceedings, which is why he couldn't make it today to the conference, we humbly apologize to all the members of the audience. However, he's conveyed his regards to all of you. He's still part of the assembly proceedings, which is why we are carrying forward with the event, and with that we'll get started with our final discussion as well. Ladies and gentlemen, once again, I'm going to request all of you to please do fill in your feedback forms. And with that, I'm going to request Mr. Sameer to also take it forward from here.
A very good evening to all of you. This is the last session, and we were incidentally supposed to be almost 5 to 6 of us on the panel, but due to various reasons we are only 3. So what we did is that between 3 of us we said that we'll have to rejig this session because it cannot go ahead the way we had planned it. We had actually sector people coming up for this session, but we have one gentleman from Standard Chartered Bank for talking on real estate. So the way we have redesigned this last session is that each one of us will sort of come here and talk rather than we have a panel running out there, and then sort of we'll share our thoughts on sector or on specific aspects relating to sector, whether tax or reforms, and take you through it. So kindly excuse us for redesigning or rejigging it, but we ensure that we'll bring enough meat in this session to depart a lot of knowledge, and hopefully you'll go home with more knowledge. Thank you.
So for a very quick introduction, I look after real estate private equity business for Standard Chartered Bank. I'll speak primarily about real estate, and if we want to just look at how the budget works for the real estate sector, I think we should just take a step back and put it in context of real estate, where the real estate sector is right now. I'm sure you guys read a lot in the press about how housing crisis is there and what's happening on REITs and so on and so forth. So I will talk about at least 2 major policy initiatives in the budget, one relating to the housing sector and the other relating to REITs, real estate investment trusts. First of all, the housing. What's happening in real estate right now is that housing industry, or the residential, urban real estate in residential sector, is in a state of slowdown. We read so much in the press about that. Even the economic survey, if I'm not wrong, I think recognized that as a challenge to the real estate sector, and it does talk about the fact that there is a lot of unsold inventory in the market, and there is sort of a price build-up that is not sustainable, which has been only sustained because of the investment to the sector rather than actual end-user purchase activity. And both these are true. So there is a build-up of unsold inventory in the urban residential real estate across all major cities in India that we track. At least we look at 8 to 10 major cities in India. And there is also a price build-up that we've seen over even during the post-crisis 7-8 years time that we've been tracking. But I think real estate sector is probably less understood because it's fundamentally different from every other or most other sectors in the sense that when we talk about inventory, we are still talking predominantly of residential apartments still under construction. So it's not as if these apartments have been built and developers are having to hold on to them without realizing cash for them, and hence their equity is really stuck in building these. So we're not talking about that scenario. Clearly, we are still talking about inventory which is under construction. So in India, what happens is, for most part, the residential end user, it's purchasers like you and me who go and buy a residential unit, who actually fund the construction. So we buy during construction, we pay in stages during construction, and hence we fund the residential construction. So this context is, once you place it in this context, perhaps the panic, at least what that means is that it's not a panicking situation. The second thing is that, yes, urban real estate prices have gone up a lot, but I think that has been parallel to that, the cost structure, input costs have also gone up. So there are two reasons why costs have gone up. Number one being that the product that you get today is at least 3 generations ahead of what was being built about even 10 years ago. So in the last 10 years, the quality of development, the amenities, what goes into building a residential project has also gone up. The second one is really that the cost of construction, the cost of input materials, cost of cement, steel, labor, etc., all has gone up, and for various reasons. But having said that, there is still perhaps an element of lack of price discovery in residential real estate. It's unlike other sectors because there is no market where the customer can go and figure out what price is right to pay for a residential real estate unit. And because of the fundamental nature of real estate, residential units, the only way to actually increase price discovery is to increase competition. And while the government is doing a lot of right things, I would also like them to increase competition in this sector. And that really hinges on two things. Number one being increasing land supply in the market. So while all the urban land ceiling acts, or most of them, have been repealed by the central government and the state governments, the governments are still controlling the supply of land. Why? Because they decide what land can be developed, what land can come within the master plan, for what land they can give zoning to the developers to build residential housing or offices or retail malls and so on and so forth. And secondly, they control the urban transportation linkages as well. So unless they build a road or bus connectivity to a location, the location is not really buildable. And that then places a lot of power in the hands of state governments specifically, because land development is a state government subject, to actually increase competition and make sure that the prices are maintained at a competitive level. Right now, I would say that is somewhat lacking in the market. The second point to note is that none of our cities were ever designed for the kind of growth that we have seen in the last 15 years. So urban rejuvenation is a very important objective. We all see so many traffic jams, so much burden on the existing infrastructure in the urban areas, and that's also becoming a pressing need. We are seeing urban pollution as a result. We are seeing urban traffic, loss of time, loss of productive time, and so on and so forth. So what the government is doing gradually, what the central government has done in this budget specifically, is with respect to affordable housing. So they have given very specific income tax benefit to developers who are building compact urban homes in major cities and tier 2 cities as well, with a cap on area of 30 square meters and 60 square meters. At this moment, there is very little residential stock that's getting built in these sort of size categories. But I do believe that this policy will help spur the developers to build some amount of compact homes in the market, which would be much more affordable to that segment of the customer who's otherwise not able to find anything that matches his budget, his or her budget. So that over a period of time, if the policy continues, should help over the next few years. The thing about real estate is when the policies are brought in and to the time actual results of these policies can be realized, there is a lot of time because building and developing and delivering to end customer takes anywhere between 4 and 6 years time in this sector. So that is why I think the policy or the budget announcement is welcome, but we will see the results of this over a period of time. The Smart Cities initiative about urban infrastructure is very welcome, because if our industry and our urbanization have to continue, which have a positive implication for our GDP growth and our income growth as well. If these have to continue, then urban infrastructure also needs to be addressed. So these are things that take a long time. A city takes many decades to build and populate. So from a long-term perspective, these are very welcome initiatives. The second area where the government has done a major positive change, is for the real estate investment trusts. What's going on in the Indian market is in the last 15-16 years, there has been a lot of growth in office development. So as more and more multinationals came in, as more and more Indian corporations grew, they needed more and more office space. And while till 2000 roughly, most developers were building offices and selling them in small pieces to small investors or small owners, that was not possible with the large companies, when large companies were wanting space, because large companies only wanted to lease spaces, and these companies didn't want to be divided across multiple landlords. So over the 15 years, a lot of what was built by the developers remained in their ownership. And as a result, the rental yields, which have ranged between 10 and 15% in the last 10 or 15 years, all the cash flow from the rental yields was going into servicing the debt that was taken for construction of all these office buildings. So really the developer of office spaces did not have an exit. The developer did not have the ability to take his or her cash out of an asset and then reinvest into a new development. So that was creating liquidity stress among the developers of real estate, builders of offices. What real estate investment trust will do is it will allow these developers to offer units in the market backed by all these assets and backed by the cash flow coming from all these leased offices. Government has done a lot. Government and SEBI have done a lot in the last 2 years' time, I would say, in streamlining all the policy initiatives that needed to be taken to allow real estate investment trust to become a reality. There have been some tax incentives or removal of discrepancies in the process as well to allow these real estate investment trusts to become completely pass-through vehicles from a taxation perspective. And the last of those was announced in this budget, in which the dividend distribution tax that would be applicable to these REITs, to distributions by companies to these REITs, has been done away with. And this is, I would say, a very major positive change, and it should give a very significant boost to real estate investment trust IPO plans of many participants. As we speak, I know that at least 5 to 6 large developers or owners of office properties or retail properties are there who would like to go for business trusts or REIT kind of initial public offering. This will also allow the retail investor in India to have an ability to participate in direct investments or indirect investments in property, which is otherwise for a small investor not there. If a small investor wants to have a investment in the property, the ticket sizes have become so big that it's out of reach for many of us. But REITs with their lower subscription amounts of maybe 100,000 rupees a unit or something like that will give the ability to a lot of small investors to participate in REITs as well. And not only to participate, but also get the benefit of diversification of assets that REITs will typically have, because REITs will pool a lot of cash together and buy a diversified portfolio of real estate assets. And these will have diversification in terms of geography. These will also have some diversification with respect to tenants occupying these properties. These will also have some diversification with respect to the age of the asset and so on and so forth. So I think this would be a fantastic opportunity, and this is also a very welcome step. Other than that, there are some smaller clarifications in the budget with respect to capital gain treatment for where the dates of agreement and date of registration are different and so on and so forth, which I'm not going into. But broadly, I think these are all welcome steps, and I'm sure the government also has a roadmap for making longer-term changes just so that the competitive process or competition in the sector only gets a boost, and also longer-term challenges with respect to infrastructure, etc., are addressed. Thank you.
A very good evening, ladies and gentlemen. Samir, Ashish, friends. As far as myself is concerned, you are aware, CA Atul Gupta, presently chairing the two important committee of the Institute of Chartered Accountants of India. One is a National Economic Affairs Committee, the second one is a IT Committee, and remained the chairman of Indirect Taxes Committee of ICI. Finance Bill 2016, Budget 2016, I see with a two perspective. One, that is ease of doing business, stability in policies. And the second one is about the tax GDP ratio. What kind of efforts can be there on the tax GDP ratio? And I was discussing with Samir in a break that if I share with you about the finance bill or a budget as a reformist budget, because why I am saying so, that a lot of brain was put in to deal with this budget, to deal with the provisions, the amendments, as far as indirect taxes are concerned. I divide the amendments, I divide the presentation in the two parts, as I mentioned. One is reformist, the another one is that we are, yes, what efforts we can put into the tax GDP ratio. In the reformist, the first and the foremost aspect which is there in the infrastructure sector, in the core sector, is the stability of the policies. Last year, in 2014, there was new tax regime. The new tax was imposed on the ports and airports, on the construction of the various government accommodations, medicals, hospitals, colleges, and then in respect to the government accommodations. But yes, this time, in this Finance Bill 2016, a benefit was given to all these kind of a contractor and the real estate sector, infrastructure sector, that since these projects having a life of say 6 years to 10 years, and suddenly we are introducing a new tax, let us give a benefit to those contracts which are started prior to the change in the policy. and the benefit is now will be available till 2020. So I will see that having a retrospective amendment in the Finance Bill 2016, there is a boost, there is a benefit which is given to the infrastructure sector, may it be the construction of a port, airports, construction of a government accommodations, schools, college, hospitals, and finally to the metro. Yes, the construction of the metro and monorail will be subject to service tax from the 1st of March, but again with the retrospective benefit that in case your agreement was prior to the 1st of March 2016, it will not attract service tax till 2020. Then my dear friends, the second reform which is very, very important to understand in this finance bill is about the availability of the more and more Senvet credit, for the Senvet credit of the input services and input to the business, to the corporates, to the industry, to the SSCs. Earlier, what was the situation? That in case you are dealing in a taxable as well as in a exempted services, only a proportionate credit in relation to the overall credit was available. But now, they have provided into the scheme of the Senvet credit that apart from the 100%, there will be the three segment of the credit. One, which will be exclusively in relation to the exempted activity, the no credit will be available as we have in the earlier schema. Now, again, there will be a second part that the 100% attributable to your taxable activity. And unlike earlier, as compared to the earlier scheme, there was only a proportionate credit. Now it will be 100% credit available for the credit which is 100% attributable to your taxable service, and it will be only and only a proportionate credit which will be available for the common services. Say you have a 3 layer of credit, 20 lakhs, 4 lakhs is for exclusively exempted, no credit. 10 lakh is for 100% in relation to your taxable activity. The 100% of the credit will be available, and only this methodology to apply, the ratio will be applied only on the common credit, which will be say 6 lakhs rupees. So it will be a more credit available to the industry, as we discuss, even the Ranade discuss about the cess which are not senvetable. The third reform which is into the pipeline, and yes, there was less discussion, no discussion at all about the GST, but I see there are certain changes which are in line with the GST. Say there was a rule in relation to the distribution of Senvet credit to your job worker. That is rule 7, that is input service distributor, and which will be available in the GST regime also. So there are changes which are into the line of the GST, and for the GST you are well aware that GST will be giving a unique benefit, that today even the Ranade speak about that you are putting a lot of cess. Now what is the problem of putting the cess? There are two problems. Number one, that cess if senvetable, if not a cascading effect, then there is no problem, because that is something like a tax only. And the second one, that when you are charging the coal, this coal energy, clean energy cess, and that is against for the electricity which are exempted under the regime of excise, that is become a cost. What I am trying to convey you, that internationally there are two concepts. One is exempted and the second one is a zero rated. So if in the proposed regime of GST and even today's regime, even if we are putting certain taxes, there is no problem at all. We are putting cess, there is no problem. But that should not be a cascading effect. Say in the Swachh Bharat cess, we have a 0.5% tax, but that is whether a really 0.5? No. The answer is it will be 2%, because every time the cycle is there. Say you are buying from a raw material, you are paying 0.5%, then you are putting certain value addition and you are selling, then again you will be paying 0.5%, then you are paying to the retailer and wholesaler. On every stage, there will be a 0.5% Swachh Bharat cess, and it will be not a senvetable, it will be a cascading effect. So real impact will be not 0.5%, it will be 1.5% or a 2%. Likewise in the GST, I foresee like for additional tax, that is they are saying 1% additional tax will be there and it will not be a senvetable. So the most important aspect is that whenever you are putting a duty, that should be a senvetable duty, that should be the set off should be available. And the second one, even if you are putting certain duties and you are making the final product as a zero rated, then you are eligible to claim the refund of the tax you have paid. So it should be a zero rated even in today's scenario as well as in the GST scenario, rather than you are putting certain excise duty. Okay, whatever I am paying in the coal, whatever I am paying the cess on the coal, if my electricity is subject to zero rated rather than the exempted in the central excise tariff, I will be able to claim the refund from the department, whatever cess or whatever duty I am paying while purchasing the coal, or even the cess on the extraction or the mining cess or something X is I am paying. The fourth aspect which is there in the budget for the reformist perspective is a common man benefit. Yeah, already discussed by Ashish, that is affordable housing and then slum dwellers. So in case you are a builder, you are into the real estate and you are constructing for the beneficiary land, for the slum dwellers, for the affordable housing and then the state housing project, all will be outside the ambit of the service tax. So the price will go down specifically at least 6% because on the real estate sector 4%. That is 4% is applicable on the housing sector under the scheme that is 30% taxable subject to a rate of 15% around exactly it is 4.5%. Impact will not be there on the real estate sector, may it be the affordable housing, may it is a slum dwellers or beneficiary land and the state housing project. Now dear friends, I am coming to the second leg of my deliberation, that is the tax GDP ratio. Now my dear friend, it is very very important to understand that globally, when we are talking about the World Economic Forum, when we are talking about the World Bank report, what is the situation? That internationally, there are the two terminologies which are being used to understand the tax GDP ratio. One is a tax capacity, that okay, based on your demographic profile, based on your geographical profile, based on your income group, how much tax you can collect into your GDP. And the second one is a tax effort, that okay, as compared to your tax capacity, how much you have collected. And it will be a very surprising note to each one of you that as per the report of the World Economic Forum and number of other reports, we are ranking on the 74th position with a 0.88% effort as compared to our tax capacity. And the countries like Pakistan, countries like Sri Lanka and the countries, other developing countries like Argentina, they are far ahead as compared to India. So there should be a serious concern, there should be a serious endeavor to see that our tax effort should be at least 1% as compared to 0.88% right now with the tax capacity. And while achieving this tax GDP ratio to a level of 1%, we should have the ease of doing business. We should have the doing business rank getting improved. So there should be a fine balance between the tax GDP ratio, the efforts put in for the tax GDP ratio, and the same time we are managing the ease of doing business. And that's why I offer you the three very very important change which are there into this budget 2016 to match up that kind of initiatives. The first one is the tax put on the levy put on the jewelry. That is 1%. Hardly makes any difference. 1% is not a difference, not a big deal. But that what will be the important that the more and more SEC, more and more income, more and more expenditure will be covered under the regime of reporting. Because there will be a kind of a reporting by the dealer, there will be a reporting by the jewelers, there will be a reporting, and even like the second aspect which I am going to share with you, that is electricity, the annual information written by the electricity. Likewise, there will be a kind of a more and more person coming into the tax ambit. Rightly mentioned, only 3% are paying income tax as compared to in our country. But gradually we have to increase this, not only on the direct taxes front, but also on the indirect taxes front. Yes, we are paying on a Colgate or on the toothpaste or on a comb, whatever we are buying, we are paying. But still, we are far behind as compared to the desired level. And the second change which you will witness very soon to achieve this tax GDP ratio and to have this kind of a reform, that is annual information written from the electricity department. Yes, central excise department and the service tax department, though not on this finance bill, but earlier to the finance bill, have introduced the mechanism that every electricity company, every state electricity board will be filing an annual information report written to the Central Board of Excise and Custom, and then one computer will be speaking to the another computer and will be seeing that yes, there are the red flags, there are the areas, there are the gray areas where we can have a more and more stringent verification. There should be artificial intelligence which will be put into the system. Yes, automatically the surveillance will be there. And the final one is something about the annual return. There will be an annual return, my dear friends, in case of a service tax, in case of excise, as well as in the case of assignment credit rules, which need to be filed first time on the 30th of November 2016 this year, and that return will be required a due reconciliation with the financial statements. So what I am trying to convey you that yes, we have a 88th rank, we have a 74th rank with a 0.88% effort as compared to our tax capacity. That gap we have to bridge, and that's why these are the changes which are being introduced either through the finance bill or prior to the finance bill to see that we are improving our rank, not only into this Transparency International or doing business internationally, but at the same time in our tax GDP ratio, which is far behind as compared to the other developing countries. So friends, this was all I wish to share with you from this dais. Thanks to the Samir for giving this opportunity. Thank you very much.
Thanks Ashish, and thanks Atul for alluding us to specific aspects of GST, the dynamics of taxes, how taxes get collected and what are the tax capacities. And I think the information that you shared on REITs was quite meaningful and helpful for people to understand. Of course, as I said, the session was supposed to be a panel with question and answer, but we have changed the format. There are some of the sectors which were originally being planned of this panel. So I just thought I made some notes and sort of take you through those sectors as well, as to share what has come in and what's happening in those sectors. So if we start with infrastructure, I think there are two major points on infrastructure. One is whether in terms of land reforms bill, which has not yet seen the light of the day. To make any infrastructure project successful project, there is a need to have this land reform bill to be in place so that adequate land can be acquired, and then one can go ahead and sort of start the development of the project. And just to give you a small example, Navi Mumbai Airport is being talked about since last 2-3 years. Even as we are talking today, there is a small patch of land which CIDCO is unable to acquire to complete the contiguity of the airport land, and hence they are not able to still float out the RFP. So obviously there was no news, there was no sort of murmur on the land reform bill, but for infrastructure to really take off, this will be one of the critical things. Second is, of course, the situation that we have on NPAs. Most of the infrastructure companies are sort of bleeding, and there are reasons why they are bleeding. It's not that they went aggressive, but to start an infrastructure project itself is a challenge, because as we talked, one is of course land acquisition, but apart from land acquisition, environmental clearances, clearances for sort of getting various other approvals within the state and central government, and then sort of starting the development. So if all these things get delayed, obviously the cost goes up, and if cost goes up, the viability of the project becomes a challenge, and that gives rise to NPA or financial situation in the sector wherever you are. So I believe there are enough hinters given by the FM that they want to lay down the roads. There is a Sagarmala project which is being proposed. So very unique project, Sagarmala, from an infrastructure perspective. It's connecting national waterways. What it means? It means that today if you want to lay down road, rail, you have to incur a cost, because you have to lay down the road, you have to lay down the rail, and then the either vehicles or tracks on wagons will move on the tracks. Here water is available free of cost. You don't have to lay down anything, right? All that you have to do is to get a specific size of vessel, small, medium, big, which can sort of transport cargo. We have a huge coastline, 7,500 kilometers, right, running from east to west. So this can be effectively used, and thereby, and of course there is a proven statistics, I need not allude to it, but yes, transportation by road is the cheapest as compared to rail or road. Road is being the most expensive. But if you look at statistics, the maximum transportation happens by road, and we tend to pay higher cost. And if you look at our logistics cost as compared to globally, it's almost 14%. So any product that goes onto the market, the logistics cost would be anywhere between 14 to 16% as compared to globally, which would be hardly around 4 to 6%. So that's the kind of comparison on logistics cost, because our entire movement happens on road. We have been only developing road and the cost is so high, whereas we know water, we have a huge coastline, we can move cargo by water by laying down appropriate national water highways and thereby reduce the cost. So very ambitious project is announced by Ministry of Shipping Sagarmala, which will connect at least east to west part of India via south through waterways, and that will probably reduce carbon footprint or will be environmental friendly as well as reduce the cost. So that's and of course there were certain announcements on airports, 160 airports likely to come up. Again, from tax perspective on infrastructure, they have said they will withdraw the tax incentives which are available to the infrastructure sector. So today infrastructure sector enjoys a tax holiday for a period of 10 out of 15 years or 10 out of 20 years. There is being a sunset clause being put, which means that effective 1st April 2017, there won't be any tax incentive or tax holiday available to infrastructure projects. That will again sort of create its own nuances, but in a way government has promised that it will reduce the tax rate. So there is an arbitrage. While the tax holiday or tax incentives are being withdrawn, the tax rate by that time would come down to 25%, which is today 30%. So that's pretty much on infrastructure. The next one is real estate, which Ashish has already covered, so I will not go deep into it except for fewer aspects where they have announced for affordable housing tax holiday again for developers. And if you ask me, in this budget, the amount of reforms or changes that have come for real estate, I have never seen so many reforms or changes coming in a single budget for real estate sector per se. I mean, you look at REIT, you look at affordable housing, you look at incentives for individuals where if you are unable to acquire a house in 3 years, you don't get tax deduction for interest that you have paid. So they have extended period from 3 to 5 years. So in a normal course, if you take a housing loan and you have sort of invested in an under construction house, if you are not able to get the house within 3 years, then the interest which otherwise you should have got as a deduction of 1.5 lakh comes down to 30,000 till the end of the loan period. So you lose out 120,000 rupees till the tenure of the loan if you don't get house within 3 years. So this has been extended to 5 years. So which means that you get 2 additional years to still acquire your house and still claim that interest of 1,50,000. So a lot of good measures have been announced. We hope with all relaxations in the REIT, we will be able to see at least, if not more, couple of REITs coming on the market, at least in this year. And that would sort of gain momentum as we move ahead. The other sector is, which I thought we'll touch upon, is power. In power, government has announced integrated power development scheme and Uday project. So thus far, power sector has been purely focused only on development or generation side. There has been not enough focus on distribution and transmission. And in this budget, we have a lot of measures being announced for distribution and transmission. So, integrated power development scheme focuses on again transmission and distribution. Uday again focuses more on distribution of power. Again, incentives have been announced from tax perspective, where you get additional 20% depreciation for power transmission projects, which is again good news. There has not been sort of lot of talk on nuclear energy, but if you look at few of the visits of our Prime Minister, especially the US and the Australia, what has typically happened is that government has been able to successfully sign nuclear energy agreements whereby government is able to procure nuclear raw material required for nuclear energy. So there is nothing talked about it in budget because this is more of public sector, nothing for private sector. But yes, behind the doors there is a lot of action happening on the power. In terms of health sector, to encourage, if you see, India has been sort of making molecules or new medicines based on the discoveries which happen globally, whether in US or Europe. There have been very few Indian origin molecules or discoveries being happening in India. To encourage this, government has brought a patent regime whereby an originator of a particular R&D product or a new molecule will be able to register the molecule in India for patenting, and this, if it is licensed anywhere in the world or in India, only 10% of that income will be taxed. So it's a major incentive where normally your income would have got taxed at 30%, but here by introducing patent regime, they are encouraging people or scientists or pharmacists to get into the discovery of new molecule and thereby only pay 10%. Apart from that, nothing significant from sector perspective. Of course, there are few major things coming in terms of dispute resolution scheme on tax side and income disclosure scheme. I'm not sure in previous sessions this has got covered or not, but these are measures taken to boost tax recovery or tax revenue, or to boost revenue of government, whereby government is hoping that almost like there are 3 lakh cases in litigation in tax where 5.5 lakh crore is the amount at stake between government and taxpayers. So the idea is to sort of see that how government can settle this 3 lakh cases and see how much they can recover. Even if they recover 25% of this 5.5 lakh crore, it's a huge amount. And that is where government is sort of, it's a very innovative thought, very simple thinking. Government saw these statistics and they said, okay, let's go for settlement, because somewhere people know their case is weak and they will not only pay tax, they will pay penalty. So by doing this scheme, they will pay tax and we will only recover say 25% of the penalty and waive 75% of the penalty. So it's a mutual give and take. If this scheme becomes successful, hopefully we'll see next year reduction in tax rates. Similarly, if income disclosure scheme becomes successful and people start declaring income, we'll again see tax impact on tax rates in future years. Many thanks for patient hearing. In case you have any questions, we would be happy to answer, else we would sort of wind up. Thank you.
Well, thank you very much indeed. Ladies and gentlemen, on that note, the floor is again open for the Q&A round. So please do raise your hands. We'll have the mics passed on to you. Any questions from the audience? Any questions, ladies and gentlemen? This is our final session for the summit. Any questions indeed? All right, then on that note, we'd like to thank all of our speakers here who are part of the final discussion indeed. Can we have a round of applause one more time to thank them for their presence as well as the insights. I'm going to once again invite Mr. Dharmesh from Times Conferences Limited to please come on stage and present a token of gratitude to all of our speakers. Thank you once again. If I may request all of you to come together for a group photograph as well. Ladies and gentlemen, on that note, once again, I'd like to remind all of you to please do take your time off to fill in the feedback forms as well. And you may please hand it over to our team members of the Times Conferences Limited, or you can also hand it over at the registration counter outside in the pre-function area. Thank you once again to all the speakers. And ladies and gentlemen, with that, we come to the end of the Budget Analysis Summit. And we thank you all for being here. We hope you had some fabulous takeaways from the summit. We look forward to seeing you in the next edition as well, when the next budget is announced. Thank you so much for being part of the evening. Thank you very much.